continue to expect that we'll see the 25 basis point cut delivered this week.
The Federal Reserve opinion is 3% is neutral. My view is 4% is neutral.
The big debate there is, do they show one more cut after September, or do they show two more cuts? And I think it's going to be a very close call.
The risk is that the Fed ultimately won't deliver as much as they should.
I don't think anyone would be completely shocked by, a more dovish bias here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, it's Fed Decision Day.
Much slower. I've just signed his document and all of the papers, and Steve Myron is now on. I have a better instinct than him. If you look, all the economists got it wrong. I got it right. They should listen to people that are smart, but they have to make their own choice.
The president expected to get exactly what he wants, with that decision just hours away. We're live from the home of Bank of America here in New York City, where some of the very best of the firm will be joining us, including the man himself, the chairman and CEO, Brian Moynihan.
And honestly, John, to me, this is the key economic indicator. What are corporate executives seeing when they look out there and see the activity at a time where it's very difficult to understand whether the labor market's rolling over, whether we're going to see ongoing weakness, or whether we're actually potentially going to see a reacceleration heading into the end of the year?
It's a really odd situation here. Across Wall Street, you've got equities at all-time highs, credit spreads incredibly tight. We've had a massive downshift in payrolls, and this Federal Reserve is spooked and is about to cut interest rates with inflation closer to 3 than it is to 2.
So it raises a question about what it would take for people to worry about inflation again. Are we seeing some kind of deflationary bubble, or sort of the opposite, that will allow some sort of soft landing? These are the questions that people on the ground can see. Yesterday, we caught up with Scott Kirby of United, and what he had to say was he actually sees an economy that's reaccelerating. The first half looked like it was a recession, and right now, what he sees is bookings picking up, demand picking up, people upgrading when it comes to the type of class that they're traveling. And this signifies exactly what we keep seeing and hearing about from a couple of different indicators.
Plus, we've got to address the elephant in the room. And the elephant in the room down in Washington, D.C. is Governor Stephen Myron. How big is the dissent going to be, if there is any, from Governor Myron at his first meeting?
Yeah, there is the expectation right now that there will be 3 dissents, and it will be, of course, Chris Waller, Mickey Bowman, and Stephen Myron, and it will be for a 50 basis point rate cut rather than a 25 basis point rate cut. What happens if it's a 100 basis point rate cut? Does this mean that Stephen Myron isn't serious about becoming a permanent member of the Federal Reserve? Does it mean he's more serious because he's trying to placate the president and wants to ingratiate himself? And what does the market do with that, right? Do they just dismiss that as an outlier, or do they start to see that as the gravitational force for the rest of the committee?
That's a flavour of things to come. Maybe for 2026 and beyond. A flavour of things to come this hour. This is the next 60 minutes on this programme. Coming up, we'll catch up with Vivek Arya on growing demand for AI. We'll speak to Lorraine Hutchinson on the strength of the consumer, and Liz Everett-Chrisberg on the outlook for small business. We begin this hour with equities coming off record highs as we count you down to today's Federal Reserve interest rate decision. Mark Cabana, the head of US rate strategy at Bank of America, writes the following. We expect the Fed to cut by 25 basis points, with a statement reflecting a mark-to-market economic assessment and limited forward guidance. Mark and Jared Woodard, the head of the Research Investment Committee at Bank of America, join us now. Gents, it's good to see you.
Thanks so much for being here.
Let's just start with expectations. And first of all, thanks for having us. 25 basis points widely expected. It's got to be about the guidance later on this afternoon. What are you and the team looking for?
We actually think that the Fed will be delivering a hawkish cut today, simply because the market is pricing in almost 70 basis points of rate cuts, this year. About 150 basis points for the cycle. And we think the Fed at most is going to send a signal that they'll be cutting twice this year and only twice next year. So in relation to where the market is priced, we do think that that's going to come across as somewhat hawkish. Now, we don't think that Powell is going to tell the market that it's wrong. But we do think that he's going to provide very limited guidance. He's not going to guide on October. The market's pricing in about 20 basis points of a rate cut at that meeting. And we just think that the market, if they're looking for any justification that this is a Fed that's going to be cutting quickly, won't really get that through the mix of communications today. Now, the market may look through that. It may know that, look, the Fed is not going to tell us that they're cutting in October, and it may be more focused on the dissents, the size of those dissents, and then what the market thinks that means for how the dissenting officials will vote in the future. The Myron dissent is key for the market. He's new. We don't know much about him and how he thinks about monetary policy today. So if it's a 75 basis point dissent or a 100 basis point dissent, the market will be taking some cue from that, we expect.
Do you think he would go as far as dissenting for a 100 basis point reduction at this meeting?
It is a low probability, but I wouldn't rule it out.
Jerry, this goes to the question of what people do with that in allocation. Does that mean just keep going into risk assets and sell long bonds? Or does this mean everything could be bid up because suddenly we're looking at unconventional policies that will lift all asset prices in the United States?
It's a great question, Lisa, because I think the moment of truth is coming for a lot of investors. Think about all the people who've been content, even thrilled, to have spare cash sitting in higher yielding accounts, money market accounts, earning 4%, 4.5%. As Mark and our economists and everyone thinks ahead to the future and we forecast a terminal rate next year of 3.25%, suddenly those higher yielding cash accounts start to look a lot less attractive, especially if inflation remains sticky. You've got a big decision to make at that point. And to your point at the top, Lisa, actually, the tension now isn't just between the soft data and the hard data, which we've been writing about all year, the surveys that are negative, and the economic data, which is holding up pretty well. It's now almost a fight between the hard data and the hard data on the labor side, and retail sales being strong. So investors have to decide, if the Fed's behind the curve, if the economy is actually getting weaker, then maybe that cash isn't looking attractive, but longer-term bonds might be good for a trade. If the economy holds up, if the airline executives and the bank executives and the retail sales data all confirm economy that's really strong, there's lots of places to go in equities that are going to be more attractive than cash. It's hard to overstate. This isn't cash on the sidelines. This is cash on the sidelines, in the bleachers, up to the press box. Amount of cash with almost $20 trillion in cash and cash equivalents today.
Well, these are diametrically opposed outcomes. This is the problem right now. You either have a completely risk-on environment where potentially you see greater inflation, or you see a risk-off environment where you want the long bond to lock in that 4% yield. You want to be in the bleachers. You want to be in the nosebleeds, right? Because ultimately it's going to be a difficult moment. What's going to be the tell? How will we know exactly which scenario it is? Is there an economic data point, or does it really hinge on the Fed's reaction function?
I think it's labor markets and credit spreads are the most important things to watch. I can tell you from speaking to a lot of investors this summer around the world and in the United States that the expectation remains that if you get economic weakness, the Fed stands ready and willing, and at this level of interest rates has some credible firepower to address that quickly. Given the discussion on fiscal policy and broader policy environment, there's an understanding, even an assumption among a lot of investors of every type, that the Fed will engage and can fix what may or may not be broken in the U.S. economy if it comes to that. And so even if you get a great moment for a long bond trade, it may just be a moment if the Fed is aggressive as they seem to be willing to be, in which case, for a longer-term investor, equity income starts to look really attractive.
Let's unpack some of that. So you said focus on two things, labor and credit spreads. So as we know, we can look at credit spreads right now, investment grade spreads, multi-decade tights. The labor market's a little bit more complex. It depends how you measure it. Unemployment's been really steady through the summer. And then you've got this massive step down in payrolls. Mark, for you and the team, do you think the step down in payrolls overstates the weakness, the broad-based weakness that you might be seeing elsewhere?
We do. And this is because we're seeing as Powell describes, a curious condition where labor supply is coming down at the same time as labor demand. Labor supply is naturally falling due to immigration policies, deportations, et cetera. And so you have to be careful in how you read the headline employment numbers in that context, we think. And it's useful to focus on labor market ratios, unemployment rate, hiring rate, quits rate, things of that nature. And many of these labor market ratios tell you that the labor market remains very healthy and actually hasn't moderated at all, at least some of them. Now, the unemployment rate has ticked up a little bit. We're going to hear from the Fed later today that they're increasingly worried about the labor market, at least in relation to inflation. They're going to overweight the labor data versus the inflation data, or at least that's what those are some of the sounds we think we will hear and see in the summary of economic projections. But generally speaking, it is an environment where if the Fed is more focused on the labor market, as we think they will be, then rates are going to probably continue to decline even more than what is currently priced. Now, we think investors should be long the belly of the curve, receive the 5-year part of the curve, due to the fact that the market is only pricing a Fed that's cutting to a little under 3%. And we think, as we've discussed before, the market is underappreciating the range of outcomes that can exist below the neutral rate where the Fed says they will cut to. The Fed's independence does come into question when you think about these things, but we see risks, at least in the fixed income world, that this is a Fed that will be increasingly dismissive of inflation, focused on the labor market, use that to justify a string of rate cuts. And if that's right, and I tell Jared that, it sounds like risk assets are going to do really well, or at least that would be my expectation.
Mark is asking a really provocative question. Why would they stop at 3? I think it's the right question to ask going into 26 because this could be a very, very different Federal Reserve. Why would they stop at 3? And how hot are they willing to run this thing into next year?
It's difficult to make predictions, especially about the future and the mindset people will be in with economic data that will also be difficult to predict. I think the point about the opacity on the labor market is incredibly important here. Where the Fed might stop and why they might, I think, depends on the data. And the message that I get from investors pretty clearly is we care about total returns that we can take home now and risk that we don't have to think too hard about. And if you suggest an asset allocation or an investment policy that requires a lot of contingent planning for the path of policy, the path of the economy, it starts to look pretty difficult. We know that there's yields available in the market today on assets that are giving you reliable cash flows. You don't have to reach out for speculative growth into the future. You don't have to reach out for speculative duration in the bond market that requires a lot of planning around these contingent policy decisions. So more and more conversations with investors that we have are focused on where can I get reliable cash flows from a business that I can understand, where I don't have to make all these grand macroeconomic assumptions about policy or the economy.
If I can just add to that, one of the things that we have seen in the bond market, and certainly you all have noticed, is that there's been a bit of a bull flattening in the rates market right now, which means that rates are going down, but it's led by the very long end. Really dismissive of fiscal concerns, which were so prominent a few months ago. And what we think is happening, at least in the Treasury space, is that investors are reducing some of the steepening positions that worked very well. But to Jared's point, they're also reaching out and they're trying to lock in duration and coupon where they can. They're just trying to get those interest rates before they go down even further. And the market may not like the fact that it has to extend right now, but it's really trying to lock in where it can because it does sense there's a big turn in the rate cycle. And later this afternoon, we're going to see evidence of that.
Jared, I just want to ask whether the prospect of yield curve control or the suspicion that that could be deployed has killed bond vigilantes.
It may be the prospect of yield curve control. It may be expectations around fiscal policy and the widespread adoption of industrial policy that might be more productive if we can try a bullish scenario on for size, for once. Whatever the range of catalysts and scenarios, I think it's pretty clear that the kinds of fears that we've heard about, some of us our entire career, haven't still been realized. Think about 6-7% budget deficits in peacetime, in an economic, and strong bull market, and the 10 years is so quiet. It's amazing for anyone who's been afraid their whole career about the bond vigilantes. When will they come? Maybe they're a much further distance off than. Well, maybe it's yield curve control that finally wakes them up. But if it's not that, it's always something else, isn't it?
If I can add on to that just briefly, there's been a lot of focus in the market, at least yesterday, due to some Bloomberg reporting, highlighting the fact that Stephen Miron, in his prepared remarks for his Senate confirmation, did talk about the Fed's third mandate, which doesn't get a lot of focus, but if you read the Federal Reserve Act, it is true there's a 3-part mandate: maximum employment, stable prices, and moderate long-term interest rates. Now, many in the market believe that you don't need to focus on that third mandate because if you take care of the first two on labor and inflation, then interest rates will be moderate. But the fact that that was mentioned has, let's say, awakened some to the notion that, oh, wow, maybe this is actually a precursor to the Fed using its balance sheet in very non-traditional ways. Now, that's definitely reading between the lines. There's not any elaboration on that, but certainly the market, I think, has been a little bit more open to that, and that may be, on the margin, contributing to some of the increased bullish sentiment at the long end of the U.S. rates curve.
This was a great way to start the programme. Gents, appreciate your time.
Thanks so much for being here.
Thank you. Looking forward to it. Plenty more still to come on this programme as we count you down to that Fed decision. Big question, how's the coffee?
Well, the coffee is great.
Yeah,
and honestly,
good.
It sounds like a
You'd come
video
back?
game. I love being on the trading floor because it always sounds like...
The sound of the Bloomberg.
Yeah.
It's music, right? It's a beautiful thing. It's a beautiful thing.
I love it.
Let's get you an update on news elsewhere with your top stories in your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thanks. House Republicans unveiled a stopgap spending bill to keep the government open past an October 1st deadline. The measure would keep agencies operating through November 21st and provide new funding for security. Democrats oppose the bill, increasing the chances of a shutdown. President Donald Trump announced a deal to keep TikTok running in the United States. According to the agreement, which has yet to be finalized, U.S. companies including Oracle, Silver Lake and Andreessen Horowitz would take an 80% stake in the social media app. China's ByteDance would own less than 20%, satisfying a 2024 U.S. law that required the Beijing-based company to divest. A close encounter for Air Force One on its way to the UK. A New York-based air traffic controller noticed a Spirit Airlines passenger jet flying at a similar altitude and on a converging flight path with the president's plane. The controller alerted the Spirit pilots to change course immediately. The planes were never in danger of exceeding safety thresholds. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next on the programme, the Bank of America senior semiconductors analyst, Vivek Arya. He joins us next, live from New York City, here at the headquarters of Bank of America, right here in the heart of Wall Street. This is Bloomberg.
The Federal Reserve opinion is 3% is neutral. My view is 4% is neutral.
If the takeaway is that we're not starting 25 basis points per meeting, I think the market sells off.
If the Fed wants to cut rates to stimulate an economy with no excess capacity, they're just going to create more inflation.
The risk is that at some point next year, the Fed says, look, we have to actually hike.
We're looking for 25 basis points later on this afternoon from the Federal Reserve. Some people looking for 50. Standard Chartered, SocGen. They're the outlier that's going into this meeting. The big question for a lot of you is the guidance. Show me the guidance for 25 and beyond into 26. Can those dots come down from 2 down to 3?
Yeah, and will Stephen Myron's guidance be actually available to it? Will his dot be included? You asked me yesterday, what does his dot look like? Unclear whether we'll see it, because they had to be submitted on Friday. Do they make an exception for him?
We're going to find out a little bit later this afternoon. That's the big tease for the decision later. Just where is Stephen Myron's dot going to be? Now, Governor Myron, of course. Your equity market shaping up as follows. Equity futures on the S&P 500 just about unchanged. We've been treading water over the last 24 hours. A little bit positive on the Russell 2000, up by around about 0.1%. If you turn to the bond market, 2-year, 10-year and 30-year bond yields shaping up as follows. Twos have settled down around 350. The surprise of the last 2 weeks coming into September was the bull flattener that Mark Cabana was talking about. The long end of the yield curve. Yields starting to come in. We've got 10s around 4.
Yeah, and Mark Cabana talking about how a lot of investors are trying to lock in lower yields, as it does seem like the Federal Reserve is dead set on lowering rates. And the question now is just what's the limit? The question that I have is, when do bond vigilantes come back, or are they a fiction? Are they going to be a novel, not some sort of nonfiction creative endeavor?
Will they be crushed by the Federal Reserve in 2026?
Are they going to be crushed by yield curve control? Have they been crushed by circumstances that seem to have moved against them?
Yields down by about a basis point so far this morning. Let's turn to tech. What a run. A 9-day winning streak on the Nasdaq 100, halted just briefly yesterday. On tech, Vivek Arya, the senior semiconductors analyst at Bank of America, writing the following. The cyclical framework still broadly favors semis, but market volatility could re-energize investor debates. Vivek joins us now for more. Vivek, good to see you.
Good morning.
Good morning. Thank you for having us. Let's just talk about your sector. It is like the only sector in financial markets right now. It's where all the focus is. Walk us through why it's having such a good run at the moment.
Sure. I think, semiconductors are participating in every aspect of the global economy, right? AI is the most prominent of them. But if you take the role of semiconductors and automotive, right, that's a multi-trillion-dollar industry that is transforming with the advent of more electrified cars, right? And semiconductors today are only 2% of the cost of making a car. So think about where that goes over time. right? Industrial look at things like factory automation, cybersecurity, medical instrumentation, right? PCs, servers, cloud computing. So what's happening is that as the global economy is getting more automated and smarter, I think that naturally increases the role of semiconductors in the economy, and we think this continues.
At the same time, we seem to have introduced a lot of political risk into the industry. There is a clash right now between the United States and China. There was some news overnight about China pushing some companies to halt the use of certain NVIDIA chips. How does that complicate things for the life of an analyst?
Sure. I think it is a concern. First, having friction between the largest designer of chips, which is the US, and one of the largest buyers of chips, which is China, is not a good thing for a global industry. The reason that semiconductors have become so profitable as an industry, right, and just to give some numbers, the average semiconductor company is 2 to 3 times more better in terms of free cash flow generation than an average S&P 500 company, right? So it's an extremely profitable industry. And the reason it has become so profitable is because it has developed these pools of excellence, right? There are certain companies who do manufacturing very well, certain who do materials very well, right? Certain who do GPUs very well, etc. So whenever you have friction in this well-balanced ecosystem, it creates a problem. But having said all that, we have to realize that, this tension between the US and China has been going on for some time. The specific article from this morning, right, NVIDIA and China is a very small part of their sales. It's like less than 5% of their sales right now. So I think a lot of this is more noise rather than something that actually impacts their fundamentals.
There's a bigger question, though, which is in the race for chip excellence, how far behind is China from the United States? Can they stop buying U.S. chips and continue to develop at the same rate when it comes to the race for AI?
Sure. No, that's a good question. See, if I look over the last 10 years, and if I just go by, follow the money, right? If I look at global cloud CapEx, Chinese hyperscalers or Chinese cloud companies are less than 10% of the global spending. Right? That's the reality, right? They are less than 10% of the global spending. China doesn't have access to the latest in chip manufacturing equipment. What is the Chinese equivalent of Windows or Linux or NVIDIA's CUDA ecosystem? It doesn't exist. So I think they are hampered because of a lot of reasons, right? But there are incredibly innovative software designers, right, in China. DeepSeek was a prime example of that. So I think somehow the industry will have to find the right balance where they are able to take advantage of a lot of the software innovations in China. But I think China as a whole, it is important to realize, is less than 10% of AI chip demand right now, which is why it is not as big a deal if you see this frequent noise about restrictions.
There's also this question about if we are going to see some sort of broadening out or an ongoing efficiency from the use of AI, shouldn't we see a shift from the enablers to the adopters, to the other companies, especially given some of the studies that have said that companies are struggling to monetize their AI investments?
Sure, absolutely. I think, so first of all, we are already starting to see that, right? Because if you look at the amount of tokens, right, consumed by Microsoft or OpenAI or Google or others, you see extremely strong growth. Every time Microsoft reports, they actually go out of the way to tell people this is how much incremental growth we got from AI. So I think we are already starting to see signs of those investments. But it's also important to realize that, infrastructure cycles can last a decade. 4G was the last big cycle. 4G deployment started in 2010, and people were deploying 4G capacity in 2020. But when you make money is actually in the first half of the cycle. So when did ChatGPT start? Late 22. So we are really only in the second or third year of what have historically been decade-long cycles. So I still think there is more room, I think, for investors to benefit from
it. Doesn't sound like you're worried about a massive misallocation of resources and a decade-long run of overinvestment that leads to a bust.
Right. See, that is very endemic to the infrastructure industry, that you're going to have invariably a period of digestion after every 3 to 4 years. What makes the AI cycle different is that it is not just these 3 or 4 large US companies that are investing. Look at the number of countries, regions, states, so-called sovereign AI. Right? This morning, there's a lot of news about Nscale in the UK deploying a lot of products. Earlier this year, all the announcements that NVIDIA and AMD and others made in the Middle East, because every country wants to be self-sufficient in this new technology, right? And the third is enterprises. Enterprise adoption of generative AI is just getting going. So I think that's why, we are not at even close to the middle stages of this build-up.
Which is unbelievable to try and imagine. We appreciate your time, Vivek. It's good
My
to see
pleasure.
you. Thank you, sir. Vivek Arya there of Bank of America. Up next, we'll head to London. We'll catch up with Annmarie for the latest with the president, and we'll have a little look at retail. Live from New York City this morning. Good morning to you all. Lucky to be at the Bank of America trading floor, anticipating that big Fed decision later on this afternoon. That decision at 2 p.m. Eastern Time. 3 hours away from the opening bell, equity futures shaping up like this so far this morning on the S&P 500. Really mild moves yesterday. Pretty mild follow through to this morning as well. Going nowhere on the S&P 500. Pretty much unchanged on the Nasdaq too. The Russell absolutely unchanged and dead flat after a really nice run through August and into September. Since the Fed last met, small caps up by more than 7%. Let's get you some single names. Let's get you some morning movers. Here's Danny Berger with more. Hey, Danny.
Hey, John. A rough morning for NVIDIA after a story from the FT saying that China is banning, or at least telling the big companies, do not buy any more NVIDIA chips. That's the likes of Alibaba, of ByteDance, the chips that are specifically tailor-made for China. Comes amid those discussions between the U.S. and China in Madrid, so those shares off 1.6%. Elsewhere in tech, the HR software maker Workday, that gets a boost of 6.4% after Elliott Management disclosed a stake in the company. In doing so, they praised the CEO, they praised the company and the turnaround efforts that they have been undertaking. So again, those shares rallying off the back of that. Finally, this morning, for your movers, you're looking at Eli Lilly, slightly down. They published a study on their obesity pill, and it showed enough effectiveness that it makes sense for a wider use. The problem with it is that the results weren't as convincing as the pill from Novo Nordisk or even their own shots or the shots from Novo Nordisk. So Novo Nordisk rises on that news, up 1.3%, and just adding insult to injury, Berenberg also upgrading Novo Nordisk, saying that it is its preferred choice for obesity pills instead of Eli Lilly. John?
Danny, thank you. Appreciate it. More from Danny in the next hour. I promised a trip to London. Let's do it. In the British capital, in the city of London, Annmarie joins us now for more. Tracking the president's state visit. Annmarie, not the first, but for the second time.
For the second time, it's an unprecedented state visit. The president talked about this as he departed the White House yesterday. He will be arriving at Windsor Castle just behind me in under 60 minutes time, so just under an hour. A lot of pomp and circumstance is going to be on display today. This is really the heart of the state visit. The president says he's mostly going primarily to see his friend. King Charles talked about their long-term relationship. And then on top of that, of course, there's going to be lots of chatter about economic deals, trade deals, and the likes. We should discuss, though, where we are right now, what the President of the United States is stepping into. Remember 7 months ago when Keir Starmer came to Washington, D.C., brought this unprecedented invitation from King Charles for a second state visit. Keir Starmer was looking quite up in the polls in the United Kingdom. It was viewed as a very clever diplomatic olive branch to the President of the United States. And at that moment, it did work. We did see the UK jump to the top of the queue. They had this fast-track trade agreement. It was announced in May. I was with the president when he was on the phone with Keir Starmer announcing that deal, and then it was signed along the sidelines of the G7. Well, right now, politically, the president is walking into a prime minister that is on thin ice with the British public, underwater in the polls. One recent YouGov poll said just 22% of British people have faith in this government, and the past 2 weeks have been incredibly difficult for him. There's forced departures of his deputy prime minister, and most notably for this special relationship between Washington and the UK. The British ambassador to the United States was sacked after revelations in a Bloomberg News article given his close ties with Jeffrey Epstein. So it's going to be a challenging one, more so for the British Prime Minister than it is for President Donald Trump, who many say has the leverage right now walking in to this state visit.
Annmarie, the UK is not doing so well. We know that based on the economic data. From what we've seen in terms of stories from big tech firms over the last week, maybe corporate America is about to bring some good news. What kind of tech deals are lined up when the president lands and addresses the king and the prime minister?
Tons of tech deals. This is really where the heart of the economic agreements are going to lie, especially given the president is going to be flanked this evening at the banquet with the likes of NVIDIA's Jensen Huang, the CEO of Microsoft, as well as an individual who is notably absent on his Middle East tour, Tim Cook of Apple, reports saying he will attend the state banquet this evening. We are talking about $10 billion already lined up to build out the AI industry in the United Kingdom. And this is really important for the UK. They want to make sure that the United Kingdom is not left behind in the next phase of this technological advancement. And also, they see it as an economic development, potentially in northern England, to bring these AI data centers and AI infrastructure. So that is going to be really the hallmark of the business and economic ties here with the President of the United States and the Prime Minister and the royal family. It's going to be all about these tech deals between OpenAI, NVIDIA, Microsoft, Google, and the list just continues.
Annmarie on tour. You enjoy yourself. AMH, live from Windsor this morning. Annmarie will catch up with you in about an hour from now. We've all heard about these tech deals. We've all talked about this AI spend. Let's talk about energy consumption. You and I started the week talking about this. In the UK, some of, if not the highest, energy prices in the G7, and you've got tech firms lining up to spend more on something that is really energy intensive. I don't think it's all good news for the UK off the back of these deals. Where's the energy going to come from?
And it goes to a question that is perhaps more acute in the United Kingdom, but is pervasive around the world, which is, can you develop AI to the degree that people want to do and at the speed without developing energy in tandem? And how do you do that given the long-term nature of some of these plants and some of these electric production places?
The consumer in the United Kingdom in a tight spot right now. Let's talk about the consumer in the United States. Lorraine Hutchinson, senior retail analyst at Bank of America, writing, we remain positive on off-price retailers and think price increases at other retailers could cause consumers to trade down. We expect this trend to continue in the coming months. Lorraine joins us now for more. Lorraine, good morning. Good to see you.
Thanks for coming to our place today.
Thanks for having us. Retail sales yesterday, really quite punchy, upside surprise. Are you seeing signs of the consumer re-engaging as we come out of summer?
Absolutely. I mean, just when you think you can count the consumer out, they do something surprising. And I think not just August, but July retail sales, the really important back-to-school selling season spans mid-July through mid-August. Those were phenomenal weeks, according to our BAC credit card data for clothing spend. And it's a surprise because we've seen about 3 years of declines in that category, and suddenly they're back.
Is it consolidated in the upper income sphere? The idea that people who can experience the wealth effect of stock markets, who do have some disposable cash, can go out and spend, but the others not so much. Do you feel like that's really the trend you're seeing break down?
I think it is. What we're seeing in our data is that the upper income consumer is spending a lot more than the lower income consumer, where we're seeing a little bit of signs of pressure. We're also seeing the upper income consumer trade down a bit. You know, and you referenced the off-price retailers. They're seeing much higher income consumers come in looking for deals. And I think that's, it's encouraging for them. It's showing you that the consumer really is very judicious about how they're spending, and they want to try to get the best value for their dollar. Not always the lowest price, the best value for their money.
How much is this that some of these off-price retailers are catering to higher income individuals simply because that is where the money has been? So they are sort of directing more of their product versus some sort of trading down or a signal on the economy that there really is fear that things are going to weaken.
They're absolutely doing that. They're seeing the opportunity to get a trade down customer, which they've been missing for the past few years. And you see, TJ Maxx always has a higher end consumer coming in to sort of peek at what brands they have. You're seeing Ross Stores and Burlington actually come in with much better branded product, and they're reaping the benefits of it.
They've had some massive gains over the last quarter. I think 10-15% for Ross Stores and TJX as well. Let's talk about tariffs. Mitigation strategies. Yep. What kind of mitigation strategies have these companies introduced, and how sustainable do you think they are?
Yeah, I mean, the first thing you do is you negotiate with your vendors, right? Can you produce elsewhere? Can you produce more efficiently? We're hearing from our colleagues in Asia that the factories are providing some relief for the cost. The second thing is, can you be more efficient as a retailer, right? What costs can you cut? How can you do whatever you can internally to try to mitigate these? And then the last thing is pricing. And that is a very hot topic right now. They will all raise prices for holiday. Not all, but most. And I think the risk here and the uncertainty, and when I speak to these retail management teams, there is a ton of uncertainty, right? We had a great back to school. But what's coming is price increases because they can't take the brunt of the tariffs to their bottom line.
Let's just build on this a little bit more. So the tariffs go on. Either the exporters can drop prices. You suggested some of that is happening. The companies here domestically can take it on margin.
Yep.
We've seen some signs of them absorbing costs. And then the third piece of this is the pass-through to consumers that you've touched on. I think this is the most important piece of this, particularly for the Federal Reserve decision later on this afternoon. What is it about this moment that you see as inevitable that the pass-through will be coming in the coming months?
Yeah, so right now the product that is hitting the distribution centers for most retailers is carrying the full weight of the tariffs. So for back to school, it wasn't. They had some inventory already when the tariffs went into place, and then they bought the rest at 10% universal. Right now we're up to, for my company, is an average of 20% universal. That's a much bigger ticket for them. So for holiday, they will need to pass through some pricing. And they've all tested, they've done elasticity tests, but it's in a vacuum, right? Nothing else has been inflationary. So now everything will go up in price a little bit. And the consumer will decide what they want to buy.
What's a little bit? Just, do you have any sense of what we're talking about?
We are hearing low single-digit price increases for the most part. And that will do a decent job of offsetting some of it. Now we still saw most of my retailers cut guidance throughout the second quarter earnings period because they needed to take some of the hit themselves. And then over time, they hope to mitigate all of it, but that would require some pricing.
There's also a question about what costs they are cutting, and this is the other side of the Fed mandate, right, which is the jobs market and how much they are reducing some of their overhead by shrinking their workforce, adopting more technology that could potentially fill in the gaps. How much are you seeing this really play out in real time?
They're looking under no stone unturned on the cost structure. We haven't seen broad layoffs or anything like that. I think it's more just about efficiency and trying to make sure that they're getting, the best bang for their buck on what they are spending. But I think it will depend on the consumer's reaction to the price increases. If it goes through, we're fine, right? If the consumer decides, and remember, I cover a purely discretionary group. You don't really need anything that they sell. So you make the choice. You decide what the price is, right? If it's too expensive, you go somewhere else. And so the consumer has a lot of power right now, and that's what's causing the consternation from the companies.
Of the companies that fall under your coverage, just a final question. Which one is operating from a position of strength? Which one can be a little bit more aggressive going into year end?
I think it's the off-price retailers, as we discussed earlier. They have a lot of flexibility in what they buy, and they have the opportunity to gain a lot of trade-down customers with great brands. So I think they're in a real position of strength. And then the others that I would highlight are anybody with real brand heat at the higher end. It's easier for them to take price because the upper-income consumer notices it less.
Lorraine, this was great. It's good to catch up and touch base.
Thank you.
Thanks for having us. Lorraine Hutchinson there of Bank of America. We've talked about this a few times on this program. Tariffs. Don't think of it as an event. It's a process. And what you just heard there is that the next step in that process is potentially more pass-through.
Yeah, and the next step is whether consumers will accept that. The elasticity, this idea of whether they really will be concerned, consumers, about prices going up 5%, 4%, or whether they'll say, okay, we'll buy that, which means you have an economy that runs a little bit more robustly, but with a little bit hotter inflation versus some sort of deflationary slowdown in growth. This is the conundrum for the Federal Reserve.
We'll have more on the consumer in just a few moments' time. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Well, in the United Kingdom, more data to support the Bank of England holding rates steady at its meeting this week. Inflation held at the highest since early 2024 in August. Consumer prices rose 3.8% from a year ago, in line with estimates. The data may lead to an even longer pause in borrowing costs. President Donald Trump says he's spoken to Indian Prime Minister Narendra Modi. In a post on Truth Social, Trump said he had a wonderful call with Modi, complimented him on doing a tremendous job and thanked him for his support in helping end the war in Ukraine. Modi responded on Twitter saying he was committed to supporting the India-US relationship. President Trump has also been speaking with Israeli Prime Minister Benjamin Netanyahu. Speaking at a press conference Tuesday night, Netanyahu said he had a number of conversations with the president after Israel's strike on Hamas leaders in Doha, and that they were all, quote, very good. Netanyahu also announced he will meet with Trump at the White House September 29th. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Retail sales came in strong just yesterday, an upside surprise. Were you surprised? If you were tracking credit card data at Bank of America, you wouldn't have been. Up next on the show, we'll catch up with Liz Everett-Chrisberg of Bank of America Institute. From New York City, you're watching Bloomberg TV.
I think 25 basis points is pretty much a done deal at this point.
They should have gone 25 already. I think 50 should be on the table.
I don't think they're going to do 50. I think it is justified.
The risk is that the Fed ultimately won't deliver as much as they should, and that kind of reinforces the slowing that we've already seen.
This is a big question for later this afternoon. Can this Federal Reserve meet this market? At the last time we got a news conference and forecast, which was earlier in the summer, they were looking for 2 rate cuts in 2025. This market is looking for 3, and it's looking for a whole lot more in 2026. The bar for this Federal Reserve is really quite high following these really disappointing payroll reports.
Yeah, especially given that they are still dealing with a dual mandate that is very much in conflict, and that they're dealing with a highly politicized environment where there clearly is an incentive, at least by the administration, to cut rates. My question is, how much will that actually increase the pace of lending at a time where financial conditions already are pretty loose?
Let's get to the small business world. Liz Everett-Chrisberg, the head of the Bank of America Institute, writes the following. Tariffs remain a hindrance to small business profitability and have continued to rise since the start of the year. Liz joins us now for more. Liz, good morning.
Good morning. Thank you guys for being here.
Thanks for having us.
Great to have you here.
Great coffee. For having us.
Oh, yeah. Great coffee.
She approves of the coffee, and you want to come back, right?
Well, I love the noises. It's great. This is great.
Okay, I'm pleased we're down with that.
We can go.
Let's deal with this. Of course, the biggest small business lender in the country.
Yes.
17th consecutive quarter. Congratulations for that.
Yes.
What are you seeing in the small business world right now? Do they need lower interest rates?
So what we're seeing, and by the way, as the largest small business lender for the 17th quarter in a row, we can see the activity because we're providing these small businesses with capital. But what we're seeing is that profitability is actually continuing to grow, and it's relatively stable. So it was up about 0.5% in August, same way that it was in July. But we are seeing that despite kind of the tariff pressures, and hiring is also a bit of a challenge. And we're starting to see hiring pull back. So one of the things that we see in our data from a spending perspective, what we measure is we measure the payments that small businesses are making to hiring firms. And that has been a pretty good indicator of what's going on with the labor market. And in August, we saw that drop by 6%. On an absolute basis, it was the lowest payment level of payments we've seen since we started this series back in 2023. So you're seeing small businesses kind of pull back on their hiring, particularly in retail and services firms, financial firms, insurance firms. But there is one area of small business where we're seeing hiring fees go up, and that's manufacturing and construction. Why is that? Very likely has to do with some of the changes in immigration policy. If you look at the percentage of construction workers who are not native born, it's relatively high.
Do you think that's the start of something bigger? We've talked about this low-fire jobs market for a long time. We're trying to work out which way it breaks. Can it maintain the sort of status quo? Does it have to break one way or the other?
So here's one of the things. Let's go look at our consumer data and understand what that's showing us about the labor market. Surprisingly, given what we're seeing in the non-farm payroll numbers and whatnot, we're actually seeing wages continue to increase across all income groups. So higher, middle, and lower income groups, you're continuing to see their wages increase. Higher income wages increased 3.6%. That is the highest level we've seen since November 2021. But lower income consumers, lower income household, their wage growth is up less than 1%, the lowest level of absolute growth that we've seen since we started this series back in 2016. So you're seeing a bit of a difference in kind of a tale of two cities in terms of different levels of wage growth, of income growth, kind of across the spectrum.
When we talk about a tale of two cities, it seems to be divided into some of the large caps and the small caps, or it has so far this year. This idea that even as the likes of United see a reacceleration in consumer demand, Are some of these smaller companies seeing the same? Is their optimism increasing heading into year end?
I do think that we are seeing payments away from hiring. They are continuing to spend. And really where we're seeing a big investment is in their technology spend. So technology spend for small businesses was up 10% last month. Now think about that. What does that mean? That means that these small businesses are investing. They're looking at AI as ways to kind of improve the productivity, but that may also impact their hiring plans, right? We've kind of, that's across the board, small businesses, large businesses, you're seeing that as well.
Well, I wonder then, if rates do go down, how much do you expect borrowing to increase? Or what kind of rate cuts would it take for a lot of these small firms to borrow more? And what would they invest in?
That's a good question. You know, one of the things that we do is we look at the data as it's happening. So what we could look at is what they have been investing in, and I think technology is probably where it's going to go.
So this actually goes to the question that John was asking, the low hire, low fire churn.
Yeah.
Is this the new normal in terms of invest in technology, see if you can do it with a bot, see if you can do it with an AI agent, and if you can't, then I guess you got to bring a body in?
Well, I think one of the bodies that we're seeing not come in is younger workers. So if you look at the unemployment rate for households, we're seeing the biggest growth in households getting unemployment being the younger consumers. So recent college grads, Gen Z, their unemployment, number of households with unemployment was up 11% in August, right? Now, it's still off of a relatively low base, but for those younger consumers, are they getting into the workforce? Low hire, low fire means that if you already have a job, you're continuing to get paid. But people getting into the workforce, that may be a bit of an issue. So something that we're paying attention to.
Have you got any thoughts on what's behind that? What's holding them back? What's holding back the hiring?
Well, I think it's companies are looking at where they can get efficiency, looking at, you know, where a little uncertainty. Do we need to bring on new people, or can we just continue with what we're doing, what we have right now? Is AI going to make that more efficient? So if you've got a job, continuing to see pay increases, but if you're trying to get into the market. Now, the other thing that's interesting is we're seeing many fewer people change jobs. That's one of the things that really drove the wage growth through the pandemic, because people could switch jobs and get a lot more money. At the peak, they were getting north of 20% to switch jobs. What our data is showing us now is actually we're down almost 25%, more than 25% in terms of the number of people who are changing jobs. So you don't have that benefit of pushing up your wages by changing jobs, fewer people changing jobs, and those who are only getting about a 7% average pay bump. So you're not getting 20% to move jobs. You're only getting 7. Fewer people are doing it. That's kind of keeping people where they are.
This labour market's not as tight as it once was, maybe. No. Perhaps that's what that speaks to.
It's not as tight as it once was, but it's also not falling off of a cliff, right? Higher wage workers, 3.6%. That's growing more than their spending, which is also relatively strong.
Yeah.
But it's more than inflation, too.
Could we talk about bank balances?
Yeah.
What are you seeing at the moment? I always
Your
enjoy going
favorite
through the
statistic.
consumer checkpoint. Yeah.
Yeah.
How are things doing?
So the financial picture continues to be solid. If you cut the data by income, by generation, everybody has more money in their accounts, inflation adjusted, than before the pandemic, with one exception, and that's the traditionalists, which are the generation above boomers, and you would expect to see them kind of pulling down on their savings. But not only do people have more money in their accounts, you're also seeing pretty healthy credit card behavior, meaning fewer people are carrying a balance, and those that are carrying a balance, the ratio of their credit card debt to their income is actually coming down. And again, it's because of the labor market. Their wages are up.
Nothing is screaming cut interest rates 50 basis points based on that conversation.
Well, and if you do cut by 50 basis points, what it strikes me is, where is that investment going to go? Back into tech. So tech is the new economy, and any kind of additional investment, that's where it's headed.
Liz, it's good to see you.
Great. Thank you guys for being here.
Hey, thanks for having us. We appreciate it. Liz Everett-Chrisberg there of Bank of America Institute. Up next on the programme, we'll catch up with Savita Subramaniam, the Equity and Quantitative Strategy Head. We'll speak to Eric Schimpf and Lizzie Hunt of Merrill Wealth Management, and Wendy Stewart of the Global Commercial Banking Unit. From New York City, this is Bloomberg.
As long as the Fed is in motion towards lower rates, I don't think that there's a reason to sell.
It's hard to short a market in front of the Federal Reserve cutting interest rates.
The risk is that, at some point next year, the Fed says, look, we have to actually hike.
I do think that these Fed cuts are getting increasingly priced in.
The market's still trying to weigh, is something really breaking?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
We are live from number 1 Bryant Park, the home of Bank of America, right here in New York City. Good morning to you all. The second hour of Bloomberg Surveillance starts right now with equity futures on the S&P 500 pulling back by not even 0.1%. Just a little bit of softness this morning. Some mild moves yesterday. Treading water going into the big one later on this afternoon. The Federal Reserve decision at 2 p.m. Eastern Time. 30 minutes later, a news conference with Chairman Powell. We are all focused on one thing, not just the size of the cut, it's the amount of guidance this chairman can give.
Yeah, and potentially how many dissents there could be. The expectation is there could likely be 3 dissents from Stephen Miron. Of course, we also are expecting the other 2 dissenters from the previous meeting at a time. That would be the greatest number of dissents going back to 1988, just to give you a sense. So, yes, we're looking for guidance from Jay Powell, but looking forward, what does that mean in terms of his tenure and how much this is a fractured FOMC?
At some point, his guidance doesn't matter. His guidance matters up until May of next year. After May of next year, it's about someone else. And maybe the clue comes from someone else. Governor Miron stepping into this meeting at the very last minute is going to offer his views on where he thinks policy should be. That's going to be a massive focal point for a lot of people in this market.
Yeah, where's his dot? Does he have a dot, considering the fact that evidently you have to submit your dot on Friday before the meeting? And he was nominated and actually confirmed just days ago. So we're looking at the potential for his dot to not even get included. But if he does suggest that we do see something like a 100 basis point rate cut, that would be appropriate in his view. If he sees rates going down to 1%, do people take that as a guide, or is that the outlier? Does that mean he's a credible replacement for Jay Powell, or even for Lisa Cook, or even for some of the others? Or does this mean that really this is sort of something that's sort of pie in the sky?
Credible in the eyes of who? In the eyes of this market? Credible? Or in the eyes of the President of the United States? Isn't this the ultimate audition to stay on the Federal Reserve for a whole lot longer?
Well, the 2 go in hand, right? The person has to be credible for markets for the person to be tolerable to the president. And this goes to the question of what is the Fed's response function if inflation starts to pick up? And this goes to the conflict in the data that we've seen where the economy doesn't seem to be falling off a cliff, but it is still that low hire, low fire type of churn dynamic that's giving some people anxiety about the fragilities that are baked in.
We spent about 60 minutes so far with the team here at Bank of America on the trading floor and putting together a picture of the way they view the world right now. Yes, we've seen a step down in activity in certain places, particularly on hiring, but it might be a mistake to anchor your whole view of this economy just around one data point, which is headline payrolls, because there's a lot of things happening elsewhere that speak to an economy that's holding up okay.
Balances in terms of consumer bank accounts, just fine. Retail spending exceeded expectations. Yesterday, the United CEO came out and said that he sees an economy that is re-accelerating. How much can this continue? How much does this hinge on just how much retailers and other companies can pass along price increases? These are some of the questions that the Fed has to wrestle with. It is a difficult moment, but right now, bond traders just betting that rate cuts are coming and potentially more as well.
Equity traders too.
Yeah, exactly.
Equities close to all-time highs. Futures this morning down by around about 0.1%. Coming up this hour, big lineup over the next 60 minutes for you. We'll catch up with Amy Lizauer on the shifting balance of power between CEOs and investors. We'll speak to Eric Schimpf and Lindsay Hans on why this is neither a bull nor a bear market. Plus Wendy Stewart as investors navigate tariff uncertainty. We begin this hour with stocks hovering near record highs ahead of today's key Fed rate decision. Savita Subramanian, the head of U.S. equity and quantitative strategy, writing the following. It is difficult to be outright bearish on risk assets with signs of profits continuing to accelerate alongside a Fed that is more likely to ease than hold short rates. Savita plus Jill Carey-Hall, the head of U.S. small and mid-cap strategy at Bank of America, joins us now for more. Guys, good to see you both.
Great to be here.
Thanks for being here. Savita, I want to start with you. A central message of your research for a long, long time. Never underestimate the resilience of corporate America.
That's right.
Is that a mistake people have made too many times this year so far?
Yeah, I think we even made it after Liberation Day in thinking that, we were going to see companies not being able to guide, not being able to navigate this really complicated environment. And what we saw was corporates handling this with aplomb. And essentially,
They continued to guide on earnings. We saw no paucity of information. We heard a lot of companies talk about their tariff mitigation tactics, which I think was interesting because they've seen this before. They went through this in 2018. Obviously, this is a little bit more extreme, but companies know how to manage. They just need a plan. And I think that was what we were heartened to see.
It's hard to have this conversation about 25 or 50 from the Federal Reserve. At the same time, the equity market is close to all-time highs. And you and the team here at Bank of America are essentially forecasting an acceleration in earnings for 2026. Can you make that make sense to people at home listening to this?
Well, yeah, we're actually forecasting a slight deceleration, but a broadening out of earnings. And what I think is really noteworthy and what investors need to pay attention to is the idea that the 493 is actually back in the black. These are companies that are making money. So it's not just tech all the time, which has been the story for the last few years. I think what's also interesting is that tech companies are spending, and they're spending on everything. They're spending on power grid, which is actually positive for overall economic growth. It's positive for commodities. And I think that's the message we're giving investors today. What's really thwarted broadening this year, I think, is just this bomb of tariff uncertainty that was dropped on April 2nd, and we're at a point where clarity has improved vastly around that issue.
Not just the 493, the 2000. And I am wondering, Jill, yes, we have seen a complete outperformance from the Russell 2000 of late, and you actually increased your expectations for some of these companies after being pretty sour on them earlier this year, especially after Jackson Hole. How much is this entirely predicated on what the Fed does, rather than what Savita is talking about, which all sounds lovely, but it's been in effect for quite a while?
Right. Well, I think the Fed has certainly been one of the biggest drivers of the Russell 2000 over the last year or two. Some of the biggest rallies and sell-offs we've seen have been around Fed expectations or data that feeds into that. So I think, the expectation of cuts coming is certainly more positive for the Russell and should lead it to outperform near term. But I think also what investors have been focused on, perhaps more so than usual, has been the profits backdrop, because a year ago, everyone was expecting that by mid-2024, small caps would have come out of their profits recession, that earnings would have broadened out and been outpacing large caps. And that just kept getting kicked out. And we finally saw small caps come out of the profits recession this earnings season. We saw a big beat by these companies. We saw much better guidance. So that's been a positive sign. I mean, the sales data, the top line growth was a bit more lackluster relative to large caps. So that's something to pay attention to as we go into the next earnings season. But the fact that profitability is finally recovering and speaks to that broadening out of earnings is a positive.
Is the pop on the heels of a potential Fed rate cut because of just simply a valuation story, that lower benchmark rates make it more attractive on a relative basis? Or is it that actually they will borrow more, that they can do more that they aren't doing now, whether it's engage in M&A, whether it's engage in acquisitions, whether it's engaging in hiring plans?
Right. I think it's a bit of all of that. I think, but for small cap companies, they have a lot of debt, much more than large caps do. They have a lot of refinancing risk. They have a lot of debt that's coming due over the next 5 years. So there's a big focus on their interest costs at a time when their earnings have already been struggling for several years now in this profits recession. So, the Fed is likely a bigger driver than usual, given that focus, given their leverage profiles right now. So combine that with some of the positives we're seeing on the profits backdrop, and I think that's a positive near term. Now, the sustainability of the rally, I think, will depend on revisions, those top line trends, the manufacturing recovery. Small caps tend to be very sensitive to the ISM manufacturing indicator, which has struggled to get back above 50. So a lot of these factors will be what we're watching to see how sustainable this rally in small caps could be.
We had a guest that came on the program a few weeks ago that said to Lisa, can you name a company on the Russell 2000? Very few people can. When they buy the Russell, what are they buying? What's the concentration risk around, say, small caps relative to Savita's world, large caps, and the S&P 500?
Right. Well, there's some sector skews, certainly, in terms of more biotech. There's a lot more non-profitable, non-earner type of companies within the index, whether it be in biotech, small cap software, regional banks, REITs. There are some of these areas that are bigger within the Russell. But I think what's important is that there are still risks to the index. There are a lot of, like I said, non-profitable companies that's elevated versus history. So I also think it's a very good environment to pick 6 stocks within the index. Our analysts here cover over 900 small and mid-cap U.S. stocks. So, amid all of these uncertainties, whether it's tariffs, whether it's how sustainable is this profits recovery, if you can focus on companies that, have better earnings revisions, have stronger margins, there are a lot of beaten down stocks within the Russell, and small caps overall are trading at these big relative discounts to larger companies. So it is a good environment for stock selection. We've seen the interest there. We saw a big uptick in attendance at our recent mid-cap conference. We've seen investors buying small cap stocks this year.
Well, when you broaden out, this sort of complicated backdrop goes to Savita, your recent change, or both of your recent change in the outlook ahead. You only see a 6% gain from here until 12 months out, until the same time next year, to about a 7,000. That's far below where a lot of other people are. Why not higher, especially given the expectation for earnings growth to truly reaccelerate?
Well, I mean, here's the problem. The ballast of the S&P 500 has been tech, and tech earnings are slated to decelerate. I mean, these companies are really big. It's harder to grow as fast. These are companies that are spending more money on CapEx, so they're returning a little bit less capital than they used to, doing less buybacks. So I think that's the other side of the story, is the theme around AI. And I think what we would need to see a much higher return and even a positive surprise in earnings at an index level is continued AI monetization, big surprises akin to what we saw in the second quarter. And it's harder and harder to forecast that as we move forward and these companies get bigger and we're more deeper into the AI monetization cycle. So our analysts are bullish, but we are still seeing a deceleration in that area of the market. And then the other kind of simple fact that we all know is the market tends to anticipate earnings recoveries. We've seen some great returns this year. I think that's in anticipation of what's to come. And, typically in the best earnings years for the S&P 500, the market actually posts kind of, meh returns. So I don't know if we're going to see another blockbuster year of returns, but I do think that earnings are going to broaden out, and that's going to be an exciting story.
Given the focus today, anticipating the Federal Reserve decision, how relevant is that to your world?
Look, I mean, I know everyone is obsessed with the Fed, but I think that long rates are much more important for equities. And we've talked about this. So, short rates have actually done very little to stymie large cap company performance because their balance sheets are healthy. They have less floating rate risk. They learned their lessons during the financial crisis and really managed their debt risk. So I think the long end is more important. And here's where it gets complicated. If the Fed is cutting, but inflation has not been, sufficiently managed, I think that's the risk. If the long end, absent yield curve control, the long end, I think, is really, potentially more dramatic for the S&P. So that's what we're watching.
Is that something you're focused on, the risk of a repeat of what we saw last year when the Federal Reserve cut interest rates and the long end actually sold off and yields rose by, I think, about 100 basis points?
Yeah, we had a real steepening. I think that's good for certain sectors and bad for others. One reason we're overweight financials, energy, some of the more inflation positive sectors that are geared to inflation. Those are sectors that can do well in that environment as long as this is not a disorderly increase in the long end, which is what, we all worry about, especially on this desk.
The good news is, so far through September, long end rates have started to come back in. Yields are a little bit low. We've seen a bull flattening through the curve through September at least.
And part of it is because of what Savita just said. As long as we don't get yield curve control, well, that's actually kind of a big caveat.
It's a question into 26.
And it's a question of exactly how much this Federal Reserve is willing to push, particularly on that long end, especially because of the focus on the housing market.
Savita, Jill, you're two of the very best. We appreciate your time.
Thank you.
Thank you. Savita Subramaniam there and Jill Carey-Hall of Bank of America. If you are just joining us, welcome to the programme. Equity futures on the S&P just a touch softer. Let's give you an update on stories elsewhere. With your Bloomberg brief is Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Republicans will hold a rare midterm convention ahead of next year's elections. President Donald Trump posting on Truth Social, the convention will, quote, show the great things we have done since the presidential election of 2024. Trump said details of when and where the convention will take place were to be determined. Shares of Nvidia trading lower in the pre-market. The Financial Times is reporting China's internet regulator has told the country's tech companies to stop buying all of Nvidia's AI chips that were destined for China and terminate existing orders. The move comes as Beijing steps up efforts to boost its homegrown semiconductor industry and compete with the US. Microsoft is investing $30 billion in the United Kingdom as it builds out the country's AI infrastructure. The tech giant plans to build the country's largest supercomputer. The plan extends through 2028 and marks the company's biggest financial commitment ever in the UK. And that's your Bloomberg Brief. John.
Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the programme, we'll catch up with Amy Lissauer, the Bank of America head of global activism and rate defense. That conversation up next. Live from New York City this morning. Good morning.
We think the Fed at most is going to send a signal that they'll be cutting twice this year and only twice next year. So in relation to where the market is priced, we do think that that's going to come across as somewhat hawkish. We just think that the market, if they're looking for any justification that this is a Fed that's going to be cutting quickly, won't really get that through the mix of communications today.
Mark Abana of Bank of America, the head of US rate strategy, offering two interesting views here. One, the hawkish risk going into the decision later on this afternoon. And two, continues to ask a really provocative question about 2026. If this Federal Reserve is going to see a change of leadership after May, why would they stop at 3%? Would this Fed run it really hot and go beyond just 3%? Now, I don't think that's Mark's base case, but he's asking a really important question we need to consider going into next year.
Well, and actually, increasingly, it's the market's base case, because when you take a look at Fed funds projections going out to the end of next year, the rate is below 3%. So that is a very likely prospect. The idea here is we were always saying, well, what does that do to the long end if you get a pickup in inflation? But in reality, people are saying, wait a second, all that money that's in the nosebleed seats up there in cash accounts isn't going to be making the same kind of yield. Let's lock in something now. And that might be part of what we're seeing in terms of the rally at the long end.
Does Governor Myron offer us some insight into what you can expect from a changed Federal Reserve for the year ahead? Let's turn to markets. Equities very close to all-time highs, pulling back a touch yesterday, again this morning. We're down by not even 0.1% on the S&P 500. If you switch up the board and turn to the bond market, 2s, 10s and 30-year bond yields going into the Federal Reserve decision later on this afternoon. 2s settling down at around 350. This move at the long end through September has been a change, though. What we saw through August was a steepening of the curve led by the front end. What we've seen coming in September is a flattening of the curve led by the long end. We've gone from bull steepener to bull flattener in just a few weeks.
Has the idea of yield curve control and potentially an aggressively cutting Fed killed off all of the bond vigilantes? Are they dead? Let's bring back Ed Yardeni and find out where the bond vigilantes, where have they gone?
Crushed by central banks.
Yeah, exactly. That's where they have been for a long time. Maybe they still are.
Let's see if that changes over the next 10 years. Let's talk about a different kind of vigilante. Let's turn to Wall Street. Amy Lissauer, the head of global activism and rate defense at Bank of America, has this to say. M&A-related demands have spiked in Q3, with activists focused on sales, strategic reviews, and divestitures. Amy joins us now for more. Amy, good morning.
Good morning.
It's good to see you. Clearly, deal activity has picked up through the last year or so. Can you walk us through how that's changed your world and whether we've seen a shift from the kind of operational pressure we might have had in years gone by to something different in 25 into 26?
Yeah, for sure. So we absolutely have seen a significant shift in terms of what activist funds are pushing for. And so you're right. If we were having this conversation a year ago, I would have said it was all operational in nature. Activist funds were saying that they can run companies better than existing management teams could, and that was coinciding with the change in CEO campaigns that were getting a lot of media attention. Now where we are is the M&A market has come back, as you've mentioned, and we're seeing activists pivot very dramatically to some of those M&A related themes where they maybe a year ago didn't think that they could successfully implement. Now the mentality is we can get M&A deals done, and that's a broad spectrum of outright sales of the company, or whether it's a divestiture or just announcing a strategic review.
Are they the kind of campaigns that CEOs are more comfortable with? Leadership campaigns are super awkward. It's like, I want to get rid of you. The guy's like, I want to stay. I'm earning good money. I don't want to go anywhere. The other kind of campaigns are a little different.
Well, it's not as personal. I don't disagree with you there, but I don't think any of these campaigns are particularly very comfortable for whether it's the management teams or the boards, because ultimately the ultimate risk is the proxy contest, which means changing members of the board, including potentially the CEO. So I think they're all uncomfortable. They're just become comfortable in different ways.
I guess I wonder exactly what is spurring the increase that we've seen last year and this year with a record amount of shareholder activity. Why now? What sort of has changed?
So a few things I think are important as we think about the number of campaigns. And I agree with you. We've actually seen an increase year over year. And we thought last year was incredibly busy. So I think what's been interesting is if we go back starting the year, we saw a lot of activism campaigns in light of the expectation that we were going to see more M&A. Liberation Day happened. We saw activism campaigns significantly decline because market volatility is not a friend to the investor community. And we tend to see actually during periods of extreme volatility, shareholders tend to be more deferential to incumbent boards. So we saw activism campaigns decline, but activists are just deep value investors and they are opportunistic buyers. We know that they had taken a lot of positions during that period of extreme volatility, and we are now seeing many of those positions that were taken resulting in campaigns. So I think that's why we are seeing a significant increase, especially this time of year, which I would say is when we start to get busy, but still a little bit early compared to most companies who have annual meetings in the spring, when we tend to see the campaigns really get more aggressive year end leading into Q1.
Yesterday, and it feels like a year ago, President Trump put out on Truth Social this idea of moving from a quarterly reporting system to a 6-month reporting system for public companies, something that he raised in his first term. I just wonder how much that would affect things for activists, whether that actually decreases their power and increases the power of the CEO.
You know, I'm not sure. I actually think companies view quarterly earnings updates as an opportunity to tell their story and to explain to their investors what they want them to hear. So whether they did that twice a year, 4 times a year, I think they might look for other opportunities to be able to do that, which companies naturally do anyway by going and speaking at conferences and going and having roadshows with their investors to make sure that they are hearing directly from the company what their message really is.
Do you find that management teams are better prepared now compared to when you started doing this? Are they in a better position now, more educated about how to respond to some of this stuff, more timely, more agile?
So definitely much more educated. And I do think the mentality at many companies is that you need to prepare for this because in some respects it's an inevitability. At some point in time, you're going to have to deal with activism in some form. But I do think some of the tactics that are used by the activists have evolved in that it's less likely that you are going to be able to get away with having private engagement and getting to some sort of agreement before it ever becomes public, because more and more of our clients tend to be surprised, meaning the activists are really savvy at accumulating positions using various derivatives. And then they can show up at a company whenever they decide to show up at the company, not necessarily when it's dictated because of 13F filings or because of a 13D filing.
We can't address live campaigns right now. I don't expect you to. But where would you suggest we look for more campaigns in the future? What kind of industries are going to pop up as being the dominant targets?
Yeah, so TMT, technology, media, telecom, continues to be the area where we're seeing the most activity. But what's interesting is actually we've seen a resurgence in real estate, which we haven't seen a lot of activism in real estate for a few years, and we are seeing a lot of activity there. So we expect there to continue to be more. I think some of that's still M&A driven.
What do you think's behind that? What's that about?
I think there is an expectation that we're going to see more M&A in the real estate sector in general. And the other sector that's similar to real estate in terms of volume is consumer retail, which we have been seeing a lot of activity in consumer retail, and it continues to be the second most common sector for activism right now.
Amy, this was great. It's good to see you. Amy Lissard there of Bank of America on the kind of pressure the C-suite's getting at the moment as deal activity starts to pick up.
Yeah, telling you who you should buy, who you want to buy, who you ought to be buying, and then, by the way, maybe leave too. I mean, it is sort of an awkward campaign, but it is notable to see how much you have seen an acceleration this time around. And I wonder whether this actually does push any companies to want to remain private, whether private companies face this in just a different way with private equity. But it definitely is an interesting moment, especially if M&A does pick back up.
There was some paralysis around the turn of Q2.
Yeah.
There certainly isn't anymore.
Which goes to the question of, are we really heading into a downturn? I mean, is this really what we're hearing from all of these
25 or
guests?
50. That's the debate for the Federal Reserve.
Exactly.
Later on this afternoon. Coming up, we'll catch up with Eric Schimpf and Lindsay Hart of Merrill Wealth Management. Plus, we'll touch base with Annmarie in London as President Trump arrives at Windsor Castle. Live from New York City this morning. Good morning to you all from number 1 Bryant Park, the home of Bank of America here in New York, the heart of finance and, of course, the home of Wall Street. Equity futures on the S&P 500 shaping up as follows so far this morning, just pulling back from all-time highs in yesterday's session. No drama. We've had quite a rally for stocks and bonds since the Fed last met off the back of 2 very weak payroll reports. In the bond market this morning, your 2-year around 350. That number was closer to 4% after the last time the Fed last met.
There has been a shift in the reaction function of the Federal Reserve to prioritize the labor market that has been sluggish. A real question here is how much is the Fed underwriting risk, and can they meet the expectations that the market currently has? And that really is going to depend not only on Fed Chair Jay Powell, but also on Governor Stephen Miron. It is hard to get my head around that. Stephen Miron, who is governor today, he was not on Monday. How much does he really push back against whatever the committee decides?
Having spoken to Stephen, Governor Miron, a few times, he doesn't strike me the kind of person who walks into a room and starts taking swings at everybody. He doesn't strike me as that kind of guy.
In a recent interview, he said he doesn't view himself as the smartest person in the room. He thinks that there are other people who are smarter, but he's okay being the most annoying person in the room and raising potential points that other people might disagree with.
The perfect balance later would be a dissent for 50 if the rest of the committee doesn't go there. I think that might be sort of the consensus view for the governor later on.
If Chris Waller, Mickey Bowman, and Stephen Miron all dissent and say that they would rather have a 50 basis point rate cut, that will be the greatest number of governors dissenting going back to 1988, and potentially at a time where that could be the real thrust of the committee heading into 2026.
After the biggest dissent since the 90s at the last meeting.
This is an unprecedented time.
2 Fed governors. That dissent is building. Let's get you some single names, some morning movers. Let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. The weakness in NVIDIA shares continues this morning with a report from the FT that China is banning some of its biggest companies from buying and using NVIDIA chips. This is different than what we had before. It was just a suggestion of not using them. This hits companies like Alibaba and ByteDance, and also suggests that maybe China is making enough strides that it doesn't need those chips from NVIDIA. So those shares falling 1.5%, just thereabouts. Speaking of Alibaba, the ADR is also rallying this morning. They're getting a vote of confidence for their AI offering. Specifically, the Chinese tech giant Unicom will be now buying Alibaba AI chips. Again, it feeds into this whole story of maybe homegrown players succeeding more. So those shares, again, the U.S. listed ones up 2.3%. Also, about 30 minutes ago, we got General Mills earnings. It's been a volatile session for the share price in reaction. First, they were higher. Now they're lower, nearly by 1%. They did have a profit that beat estimates, and they said it's kind of because of a weaker consumer, that a value-oriented consumer is cooking more at home, so they're doing more grocery shopping. But it's part of that. The issue was flagged that more consumers are buying private label products and making smaller purchases because some of that stress, hence why you start to see some of that share price reaction reverse. John?
Danny, thank you. Appreciate the update. More from Danny in the following hour to get you some movers going into the opening bell. Let's head to London just briefly. I want to catch up with Annmarie. She's over in the UK at Windsor Castle as the president arrives for a state visit. Now, Annmarie, a lot of people enjoy the theatre, the pageantry. Is it anything more than that in the British capital this morning?
At the moment, it is pure pageantry happening just behind these fortress walls of this castle right now. The president being given a tour, really, of Windsor Estate by a carriage. We're waiting for a fly pass with Red Arrows and F-35 jets at some point soon that will really show, fortify to the world the defense posture of both these countries working together. Then this evening there's a banquet, and then we slowly start to move into some more of the substance of this meeting outside the pageantry of the state visit with the royal family. This evening the president is going to be flanked by the top American executives like Microsoft Satya Nadella, like NVIDIA's Jensen Huang, like OpenAI CEO Sam Altman, like Apple's Tim Cook. Larry Fink is also here, and all the capital is being directed towards AI. We're talking about tens of billions of dollars. As the president was touching down overnight, we were looking at $30 billion commitment from Microsoft, with the Microsoft saying on their blog post is the biggest financial commitment in any country outside of the United States. So really a massive win for the United Kingdom when it comes to the tech sector, and something notoriously needed right now by this prime minister. It's a very different position than 7 months ago when he first extended an invitation for an unprecedented state visit for President Donald Trump.
Annmarie with the latest at Windsor Castle. Annmarie, thank you. We don't do a lot of things well. I'll be the first to say that. No one can compete with the way we do this.
The pageantry?
It's just amazing.
You guys absolutely nail it. Although I can't say you guys. Aren't you American now?
Not yet.
Okay, but you're kind of
About
like
to be,
getting
but,
there.
you know,
so,
like, you know, I'm a
you
guest
still
in this
pay,
country.
I know, you still
Married to an American,
you still spell
feel
labor
American,
Labour,
very pro-American.
which is just ridiculous.
I make spelling mistakes now and again.
Absolutely ridiculous.
Okay, and I say things like aluminum
fake.
instead of aluminium. That makes me American.
Fake
right?
speech.
You know, like I'm making a transition.
That's good.
slowly.
Okay, slowly.
Get there. Okay, let's move on.
But this is good.
Good. I'm pleased we agree on that. Okay, after that tangent, let's turn back to Wall Street. The team at Merrill Wealth Management writing the following. It's not a bull or bear market, but rather a bold phase where fundamentals are improving, expectations are low, and surprises are skewed to the upside. Joining us now for the discussion, Eric Schimpf and Lindsay Hartz, the co-heads of Merrill Wealth Management. Guys, it's good to see you both. Thanks for being here.
It's great to be with you.
Yeah, good morning. Thank you.
Lindsay, let's start with you. $3.7 trillion, I think, in client balance sheets right now, client balances at Merrill. Where is that money going? How pro-risk is the appetite of your clients at the moment?
Yeah, our clients have a lot of different perspectives at any given time, John. But when we think about right now, I'd say the two things they're talking to their advisors the most about are how do the headlines impact me and my portfolio, and a bit maybe around our stock's a little rich. What about market valuations? You know, should I wait for a pullback? So when we think about things like valuations, it's a important checkpoint, but it's not an overall indicator of market health. We really think when we look at the market, we feel really good and we're very bullish. We look at a number of things. The amount of cash on the sidelines, as you said. It's a very solid profit cycle right now. We have an accommodative Fed. We have an equity market rotation where we're getting broader participation beyond tech. So all of that bodes really well for our clients, and we're quite bullish at this time.
We're looking for this rate cut later on this afternoon. Eric, could be 25, could be 50. We're looking for more than that going into 2026. What kind of activity changes do you expect to see off the back of these rate cuts in our future?
You know, at the heart of our business, what we do is advisors have relationships that are personal, built on trust with clients. And the Fed might do something today, 25 basis points, or you've been discussing it all morning. But at the end, it comes down to those individual tailored discussions that clients have with their advisors. And if the Fed gets accommodated, some of the things that Lindsay talked about that could make the market continue to rise, I just would encourage clients to have those discussions, you know, with their advisors.
Okay, well, let's talk about those discussions. Let's say the Fed cuts by 50. Then do you go to your client and you say, with respect, what are you doing in cash, right? I mean, the idea of cash on the sidelines, like Lindsay was talking about, Eric, I mean, is that essentially the trigger? What is enough to trigger cash on the sidelines? It's actually earning income to move into other areas.
I think it's all built, you know, on the work that's done prior to an announcement like this or prior to a change. Because, again, it's rooted in this idea of having a plan. And so Fed makes a cut, volatility in the market. It's a perfect opportunity just to talk to a client and say, hey, we've prepared for this. The time is now. You know, maybe the rates you're earning on your cash aren't as attractive as they used to be, and maybe it's time to put some risk back on. We've probably started to see that over the last few months.
Yeah, I would say two other things. When you think about the power of being in the market, if you look at the period of 2020 to 2025, had you been in the market on the best 10 days, that portfolio is up 33% on average. Had you missed those best 10 days, you're up 18%. So just our advisors constantly, you know, remind clients that. And the other thing about the accommodative Fed and, you know, the cycle that we are probably entering into is our clients who are already borrowing from us, our high net worth and our ultra high net worth clients, despite the prior rate cycle we're borrowing, are only going to do that more. Clients want liquidity solutions. They want to protect their capital. They want to preserve it. They want to grow it. They want to pass it down. They want to transfer it. So they increasingly come to us for that. And that is a key asset and part of being Bank of America, because we have access to a balance sheet that allows us to provide very customized liquidity solutions. You may have seen we announced the Merrill Lending Solutions Group last week, which is really to accelerate that growth.
Lindsay, you point to something that's really important, which is the competitive landscape and sort of the pitch. And right now, the competitive landscape arguably has never been more robust on every front, given how lucrative this can be and how much money there is in wealth management. Where are the biggest opportunities for growth for your wealth platform, given that you already have a pretty big footprint and a certain reputation?
Yeah, I mean, we think about our clients, what we know they want. They want big when it matters, but they want it to feel small and very personalized to them. So big when it matters is they want open architecture, full suite of traditional investments, alternative investments. They want access to lending solutions, and they want personal banking delivered at scale. And they want that to feel unique They want their advisors to be their quarterback. So that is on a client-by-client basis. That's our biggest opportunity of how we deliver that to more clients. And Eric, maybe on
I think if you take, one of the things Lindsay mentioned was alternative investing, right? It's a segment of assets that has really become popular. We've seen a shrinking of the number of companies that are going public, over the last 10 or 15 years, fewer companies going public. So a tremendous amount of private businesses and companies looking for investment and need in capital. As I was saying earlier, diversification works. Cash, equity, bonds. Well, we think across all risk tolerances, there's room for an alternatives portfolio as well. And so it could be a great place to see growth for our business, an opportunity for clients, cash on the sidelines, moving in. Our firm, proud of it, Merrill is probably the originator of sort of offering these things. And we probably bring anywhere from 50 to 60 new offerings on an annual basis. And just last week, we sort of announced a new offering for a really distinct, part of our population, niche, unique, institutional-like, but direct to sort of the retail client.
Just build on that a little bit. Use the word diversification. What kind of diversification are alternatives actually offering right now? When we've been talking about private markets with a lot of people, particularly private debt, they've been talking about exactly the same kind of thing we're talking about in public markets, which is AI, massive capex expenditure, and getting exposure to those kind of investments. How much diversification is there?
Well, in the alternative space, there's plenty. There's private equity, private credit, infrastructure. You see the introduction of sports teams. Professional sports. So a tremendous amount. I do think the artificial intelligence sleeve, very interesting for alternative investing, but I think also sort of interesting what can happen, in a wealth management business with the use of artificial
build on that, and I'd love, Lindsay, your thoughts. How much is AI changing the way you do things, or how many advisors there are, or how the advisors deal with clients?
I mentioned earlier around our clients valuing the high-touch aspect of our business, but access to big breadth of solutions. So when you think about AI in a full-service wealth business, you think about it primarily on how do you make our advisors and their teams more productive to be client-facing and serve clients in a more personalized way. So how we can save time on tasks that really help prepare for client meetings, think about the post-client meeting process. That just gives advisors more capacity to be able to be face-to-face with people and really solving increasingly complex needs.
Because if I'm a high net worth individual, I'm not, but if I was, I would not want to speak to a robot, would you?
Right. That's right.
It depends. If the robot's really nice to me and brings me treats,
that wouldn't do. I'd want to know that additional work was there and being carried out by a human being.
All right. No, I think that's right. But what if that robot were really attenuated to who you were?
Would not make a difference.
What if it really brought you things?
I'd want lower fees. Wouldn't you? No,
yeah, that's true. That's true. You automatically just assume that it's free. Do you know that they're now the digital employees or robot employees that are actually called employees in a lot of different
And they're
places?
in group chats and stuff?
Yeah.
Have you guys got any of this? Got any of the chat bots on group chats?
No, we don't. I don't think you'd be surprised that the heads of Merrill Lynch believe that advice is best delivered by humans.
There you go. Yeah. We'll leave it there. Guys, it's good to see you both. Thank you.
Great to see
Thanks
you.
for having us.
Thanks for being here.
Eric Schimpf there. Lindsay Hans of Merrill Wealth Management. Equities at the moment still just about negative by 0.1% on the S&P 500 as we continue to count you down to that Federal Reserve decision. Let's get you some news elsewhere with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Mortgage rates fell last week to the lowest level in nearly a year, spurring a surge of refinancing. According to the Mortgage Bankers Association seasonally adjusted index, applications to refinance home loans jumped 58% last week and were 70% higher than the same week a year ago. Apple iPhone sales in China fell 6% year over year in the weeks leading up to the iPhone 17 launch. According to Counterpoint Research, sales of Chinese-based phone makers experienced a slow summer. The country's overall smartphone market shrank 2% in July and August, despite government subsidies to encourage consumption. Eli Lilly's experimental weight loss pill helped adults with obesity lose 11% of their body weight. While the pill didn't prompt as much weight loss as Lilly's Zepbound shot and rival Novo's Wegovy, doctors say it will be easier to produce and to use. Eli Lilly said it will file for regulatory approval by the end of the year. And that is your Bloomberg Brief. John.
Vonnie, appreciate it. Thank you. More from Vonnie in about 30 minutes' time. Up next, Wendy Stewart, the Bank of America president of Global Commercial Banking. That's next. You're watching Bloomberg TV.
Fed is cutting, but inflation has not been, sufficiently managed. I think that's the risk. Short rates have actually done very little to stymie large cap company performance. Absent yield curve control, the long end, I think, is really potentially more dramatic for the S&P.
That was Savita Subramaniam, the head of equity strategy here at Bank of America. Speaking of Bank of America, great timing. Just got some breaking news for you. This headline right here, amazing to think about. We're talking about weakness in the labour market, the Federal Reserve cutting interest rates by anywhere between 25 to 50 basis points later this afternoon. And then the team led by Brian Moynihan does this, raises the minimum hourly wage to $25, increasing the starting salary to more than $50K. That's quite a hike from this team.
Especially at a time when this is so important for people, given the inflationary impact that a lot of people have been feeling, and the lower income spheres, the more income people get, the better it is. We want to ask him, of course, about what the staffing looks like, about what this means in terms of the type of people that they're trying to hire, how they're accessing talent, and what they're seeing overall in the backdrop of the labor market.
Starting salary for full-time U.S. employees at the bank has gone up by more than 20K since 2017.
Yeah.
This has been pretty consistent. And I guess a couple of questions for Brian in about 10 minutes' time. Is this a reflection of the labour market, or just a reflection of his effort that's gone a big push for the last something like 10, 15 years?
Yeah, how representative is this of corporations around the country versus a Bank of America specific push, given the type of people they want to attract and also the way that he's organizing the business?
Brian Moynihan, the chair and CEO of Bank of America, on this and a whole lot more in just a moment. Let's catch up with Wendy Stewart of Bank of America with this to say. Contrary to expectation, companies are still exploring international expansion. Companies are purchasing other companies to expand their geographic footprint. Wendy joins us now for more. Wendy, good morning. It's good to see you.
Good morning. It's great to see you all.
Thank you for having us. That line is going to be quite a surprise to a lot of people. After April 2nd, I would have thought everyone just sort of hands off, stepped back and didn't want to do a thing, particularly internationally. Why do you think that hasn't been the case?
Well, so this has been an interesting year. And, when we think about the volatility that our clients have faced, they're also looking at how to turn that into a strategic advantage. And in global commercial banking, we've talked about the volatility and the economic uncertainty, and we've called it the T's and the I's. Clients are facing tariffs, trade, taxes. If you think about interest rates, inflation, immigration policy, and yet through that, they still want to grow. And whether that's growing domestically, growing internationally, growing organically, or growing through acquisitions, our clients are focused on growth. And one way to do that is internationally. And, I'll give you two examples of companies that have done just that. We had a client that was based in the Midwestern United States, and they were looking at filling a geographical gap that they had. And they didn't have any exposure into South America. And so they acquired a company this year in Brazil, and they did it for a couple of reasons. It was a good way to close a strategic gap. They wanted that geographic footprint, and they were able to get closer to the clients. And so a lot of people would think, well, why would they do that this year? But again, they are looking at how to take the volatility that exists and turn that into a strategic advantage.
How are they financing some of this growth? More broadly, not just that example. What does loan growth actually look like at the moment? Have things picked up?
So loan growth has been a pretty good story for us. It has been for many years, and this year it has continued. And so in that example, clients going to use debt to finance some of it. They'll use cash to cover some of the cost of that acquisition. And we're there to provide that financing. And, we've seen, no surprise, but earlier in the year, we did see a spike in revolver utilization. So if you think about clients getting ahead of the tariffs at that time in the spring, they weren't exactly sure what would happen. And so, they were building inventory. We also have seen a lot of good lending opportunities for just regular corporate purposes. And some of that has been M&A.
How much easier has it been for you to compete given the reduction in some of the regulatory overhang? And we've heard about this from a policy perspective. Does that really increase your ability to expand the lending book?
So, for us, what has happened with the regulatory environment or not, frankly, hasn't really impacted our ability to lend or not. We have been following our responsible growth mantra for many years. And from a client selectivity perspective, with the type of company that we cover in commercial banking, the regulatory environment hasn't impacted that so much. These are strong companies. They've got strong cash flow. And so we just haven't really seen that impact our ability to help those clients.
How much would it take in terms of Fed rate cuts for the clients that you work with to really accelerate some of their lending?
So, it depends on the company. It depends on the industry. We have clients obviously very interested in what happens later today. But it's not only impacting lending, it's also really impacting our corporate treasury teams that work with clients. And so if you think about what they're having to contend with, one has been around interest rates, and not just in the United States, but around the world. And so when you think about what's happened, in many cases, rates have come down where central banks have cut. In some cases, central banks have held rates flat. In a couple of cases, central banks have actually increased rates. So how do you manage all of that? And what we're seeing is another way that clients are taking that kind of volatility globally with their cash flow and turning it into a strategic advantage by managing it very effectively. And we're helping them with that in a variety of ways.
FX risk has to be another consideration. We've seen a lot of dollar weakness in a year where I think a lot of people expected dollar strength. How have they pivoted to handle that situation?
So a couple things. We saw clients do a lot in terms of onshoring, reshoring, nearshoring, call it what you want, over the last couple of years. And they did that to reposition their supply chains. And so as a result of that, they have been able to manage through some of the challenges that supply chain gaps have created. But it has created volatility with interest rate and FX risk. And so for FX in particular, what companies have done is to say, OK, how am I going to manage that? And what we're helping them with is looking globally at all of that exposure and then putting a net hedging investment strategy in place so that they can manage that effectively.
This has been one of these surprises of 25 so far. We came into the new year and we were looking for certainly tariffs, and we got tariffs, that's for sure. But as a consequence, we were looking for some dollar strength, and it didn't come. Dollar weakness was the feature of this story that I think was widely anticipated coming into the new year.
And to your question, and I'm still sitting here thinking about it, how do companies deal with this? Well, how much do they buy, say, an outpost in another country and just have no currency differential? I wonder how much that accelerates international purchases given the sort of extra risk that is potentially an easier hedge by just being there.
Based on what Wendy said, we've certainly seen a lot of that so far in 25. Wendy, it's good to see you.
Thank you very much.
Thanks for being here. Wendy Stewart of Bank of America. Just how much of a difference will a 25 basis point rate cut make later on this afternoon? How much of a difference will 50, 75, 100 make to some of these clients?
It depends on exactly what the trajectory is, but it sounds like maybe quite considerably, but it depends where on the curve this goes, right? If this does unleash a rally like we've seen over the past couple of weeks in the long end of the yield curve, well, it could be quite a bit. And I think that has also been the surprise, at least of late.
We've been here for 2 hours now.
Yes.
I haven't heard a really, really strong case for a reduction of 100 basis points to the Federal Reserve based on the economic activity that this company is tracking.
Put another way, everyone who's come on the show has talked about an incredible reacceleration going on and stability, as well as corporate flexibility in the face of a lot of uncertainty.
In just a moment, we'll catch up with the man himself, the chair and CEO of Bank of America, Brian Moynihan. Plus, we'll talk about the latest data with Aditya Bharve, and we'll catch up with the Bank of America co-president, Jim DeMar. From New York City, this is Bloomberg.
Continue to expect that we'll see the 25 basis point cut delivered this week.
The Federal Reserve opinion is 3% is neutral. My view is 4% is neutral.
The big debate there is, do they show one more cut after September, or do they show 2 more cuts? And I think it's going to be a very close call.
The risk is that the Fed ultimately won't deliver as much as they should.
I don't think anyone would be completely shocked by, a more dovish bias here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is the third hour of Bloomberg Surveillance live at number 1 Bryant Park, the home of Bank of America here in New York, anticipating a decision that I feel like we've been anticipating for a long, long time from this Federal Reserve. Ever since we got that jobs report in early August for the month of July that really started to spook not just the market, but the FOMC. There's been an expectation this Federal Reserve will cut interest rates. As we arrive here at the meeting for the second day in Washington, D.C., as that meeting concludes, the real question is not if, the question is just how big.
And what do they indicate, given the changed composition in the Federal Reserve, even though, as we've just been talking with people at Bank of America, it doesn't seem like this economy is falling off a cliff by any means, right? So if that's the case, what exactly is the incentive? What's the trigger point? What's the understanding of neutral? And this is the reason why we also get a statement of economic projections today. It could be very interesting, not only what they say, but what the dispersion of views are on that committee.
Some real questions just how much that SEP is actually going to change. Unemployment really hasn't shifted that much at all over the summer. And this is a Federal Reserve that doesn't forecast payrolls. It forecasts unemployment. The expectation for a lot of you, I know, is that the dot plot shows an additional rate cut. So the two that were already in the previous round of forecast. But beyond that for 26, I'm not sure how much this Fed can offer this afternoon beyond just risk management, or whether this Fed wants to be that aggressive.
Mark Cabana earlier here at Bank of America was talking about how there's this third mandate that suddenly is taking more oxygen out of the room, which is the idea of rate stability or moderate long-term rates. How much does that become a new third mandate that requires some additional tools by the balance sheet on the Federal Reserve that gets recognition and discussion today? And that actually could be the reason why people are jumping into the long end before, I don't know, something like yield curve control.
It's a better behaved bond market so far. Yields are down on the session by about a basis point on a 10-year maturity. Let's get the next hour set up for you. Coming up, we'll catch up with the Bank of America Chair and CEO Brian Moynihan on the latest leadership shake-up and a whole lot more. We'll speak to Aditya Bave as we break down the latest economic data, and Bank of America's new co-president Jim DeMare as we count down to that Fed decision later on this afternoon. We begin this hour with a leadership shake-up at Bank of America. Brian Moynihan recently naming Dean Athanasia and Jim DeMare as co-presidents. The firm writing in a statement, quote, Athanasia and DeMare will drive company-wide initiatives focused on long-term growth and returns and oversee Bank of America's 8 lines of business. I'm very pleased to say that joining us now is the Bank of America Chair and CEO, Brian Moynihan. Brian, of course, in London, and we're here in New York. You're actually in our home and we're in yours, so thank you, sir, for making that happen. Brian, let's get to this leadership shake-up because we've got a lot to talk about. 8 lines of business. 2 very prominent individuals in this bank, at this institution. How do you and the team plan to split up responsibilities?
Well, it's good to talk to you both, and thank you for coming to our great corporate headquarters. Hopefully they're treating you nicely out there. Look, this is a recognition of 3 teammates, Dean and Jim and Alistair, and the contributions they made to our company, and bringing Jim and Dean to help me leverage across the businesses. And there's a lot of initiatives we conduct across the company, our growth work streams, our operational excellence, our AI initiatives and things, and I've asked them to come help me. Meanwhile, it also frees up space for that talent group, and you're talking to a lot of them today, whether it's Lindsay or Eric or Wendy and others that continue to drive those 8 businesses for us and own the businesses, own the responsibility for P&L, and there's a lot of talent at that level. So the idea is to bring them to help leverage my time, leverage the company's time, leverage the company-wide initiatives, and then let that talent that drives those businesses keep making great progress.
Brian, there is an obvious, perhaps uncomfortable question. Some people might have responded to this and just thought, is Brian setting up for succession? Or is this just about changing how the company's run?
Well, long term, we have one of the duties that I and the whole management team owes the board of directors is a series of candidates that have the experience to run this company over time. I'm not going anywhere in the short term, but in the medium term. But it takes a while to set that up and get people used to the size and scale of this company. So you all report all those ins and outs of succession. But the reality is we're a team and we're driving for it. There's a lot of talented teammates, and the board will have to make a decision someday based on the facts and circumstances at the time.
Brian, you talk about some of the new initiatives and looking forward to the bank, the Dean and the Jim that will be of the future partnering together. I'm wondering what you're hoping they can accomplish, whether it's the AI initiatives or beyond. What kind of projects you're hoping that they will spearhead?
Well, we have a lot of things going. For the last year, we've been working on some work streams to help drive expense efficiency and implementation of new technologies, and at the same time drive growth, how we take risk and continue to look at our risk parameters. And so what I'm asking them is and they've helped drive those while they've been doing their old jobs, and I've said, come do this full time, and that'll give us more leverage across the platform. Our company has a great reach. We have, we're all over the globe, and Bernie Menz and the team here out of London run all the international businesses for us. We're in a lot of countries, a lot of teammates around the world. We just announced 1,000 more teammates that we're building out here in UK, and they can help the company drive that and put the key of the top big company like ours is to work the seams, work the business connections. And so Jimmy and his capabilities as he works with the wealth management group and Lindsay and Eric on the clients that we have, especially in the higher end clients that he has relationships with who are hedge fund operators and things like that. So there's a lot of initiatives, but it's really about revenue growth, organic revenue growth and expense efficiency, and also thinking through how technology applies. And it just gives me more power at the top of the house to join us, and these teammates have done a great job.
I imagine it's going to be united front at the Investor Day in November, the first one in some 15 years. You mentioned the CFO, now Executive Vice President, Alistair Borthwick, said this: the most important thing from our perspective is we feel like we've got an opportunity to close a relative value gap. Brian, can we talk about that relative value gap? Where do you think that comes from? What is it that you think perhaps investors don't fully understand?
Well, as you look at the company, you have a great organic growth engine. So we'll do 1 million new checking households, and our average checking balances are 3 times, 4 times the industry norm, and we're building that up. What we're trying to showcase is what Bank of America is an organic growth machine on a very steady compounding basis. So if you look at the projections for our earnings growth rates by the street, they're faster than the average company as the balance sheet reprices and things go on. But what we're really trying to showcase is to put on the table basically the metrics that we run this company by across the 8 lines of business and how they work together, and then the international piece, and then AI and some of the other things we work on, the payments business, which is embedded in the lines of business but is a separate business. It really showed 3 things. We have a competitive position that no one else has. We just announced yesterday the largest small business lender. We have a competitive growth rate in the organic growth that's there, and then because of our the dynamics of our NII lift, which it will be growing, as we've told people, 6 to 7% this year, you're going to see the EPS keep kicking in and the operating leverage come into the business, and the return on tangible common equity keeps moving up. And that's what we lay out. But it gears off that good core organic growth with the right risk that we drive this company by.
Brian, as John was just mentioning, this is the first in 15 years. Why now? What changed for you? And is this going to be a new annual thing?
I think we have 35 analysts that cover us. We spend time at all the conferences. We spend time individually. But think about it, putting on the table where the company stands right now as we see after the pandemic and after the interest rate changes and after inflation fights and all that stuff. We see that people putting on the table where we are in organic growth and how it works together is critical. And I think, you should expect us to do it more often. We have a lot of connectivity to the people who actually own our stock and talk to them all the time. But this is a chance to sort of lay it all out so everybody can see it together. And to look at some of these initiatives that are unique, like our employee banking investment initiative, our Continuum, our Merrill Edge through Merrill Lynch and the private bank, and the ability for us to take a customer literally from their first bank account their entire life, and no matter what happens to them on an individual side, or a small business forming today that becomes the largest company in the world, or an individual trader that builds up a capability and becomes a hedge fund manager. The idea of these continuums and things like that are really important. And so we hope to put that on the table and make sure people see it, and then we'd annually update it, but sort of put a baseline on the table.
So, Brian, it seems like you're moving toward a greater degree of transparency, or at least availability, at a time where the president is talking about potentially moving from a quarterly reporting system for public companies to a 6-month reporting season. Do you think that would be helpful for you as a business manager if you had to report less frequently in terms of filing?
In the end of the day, we run the company along the principles of responsible growth and how we run it. So it won't change how we run the company. It may change how often we have to talk about it. And inherently, if you do it 2 times a year versus 4 times a year, you'd save some money and some effort. But my guess is our investors are going to demand from us more constant reporting. So we'll see it all play out. It's an initiative that was talked about over the last several years. If it's going to get done, it has to be done the right way, so it remains in place. And we look forward to what comes out of the SEC in the process. But on the other hand, we are very transparent in what we do. We put a lot of information out there, things like our digital capabilities that no one else reports on, quite frankly. And again, with the Investor Day, we'll be able to show that and really challenge people to say, look, if this is what's going on, if you've taken a company that had 300,000 people 15 years ago that has 212,000 people today and applied that technology, just think as we start to apply AI more fully, we already have Erica, 3 billion customer interactions, but as that applies more fully, you'll see the ability for us to continue to manage the headcount in the company well while the revenue keeps growing. And so I think we'll report on that more often than every 6 months is my guess based on the demand of our investors.
Lisa, I imagine some CEOs might welcome this.
Yes.
Even if some investors don't.
They might welcome this, but will they be allowed to actually follow it by their investors? And that, I think, is what Brian is alluding to.
I think investors will demand much more transparency. Brian, I want to talk about an initiative close to your heart. The news that we got about 15, 25 minutes ago, that you're increasing the minimum wage to $25 per hour. I remember a very early conversation with you, and this is something you're very proud of. This has gone up from, say, 15 several years ago. Can you talk to us about why you've maintained this commitment to driving the minimum wage higher at Bank of America?
Sure. So let me set two things up. One, over the course of today and tomorrow and yesterday, we've announced a series of initiatives. One is to locate 1,000 new teammates in the UK that will work in our operations group, and that was announced by Bernie and Tom Scrivener. A second one is to recommit to our military hiring at Bank of America, 10,000 military veterans over the next 5 years. We've done this from time. We have about 20,000 working to increase that. Another is to increase 8,000 people from community colleges to present an opportunity at Bank of America to further the career and get into skills-based training. That's a doubling or tripling of what we do today. And then with the 75 branches that we're deploying and the teammates there. And the third piece is the minimum wage. And so we started on a travel a number of years ago with a view that we want teammates to come to Bank of America with a career mindset. So join us. So today we're announcing $25 an hour, which is $50,000 for a starting salary across the country and higher in some places where the prevailing wages are higher, obviously. But what that gives a teammate a chance to join our company, spend their whole career here, and support their families. So not only is it the $25 an hour minimum starting wage, it's the benefit structure, which is a full 401k match, a full benefit cost that for the teammates in the brackets of $25 an hour, we basically dropped their premium coverage in healthcare in 2012 from $500 a month to $250 a month for family. Have never raised it to provide great health care for them, and then our child care benefits. So it's a package. So where's that payback for the investor? Where that pays back to the investor is the turnover rate when we started this program in the high volume operations groups and the branches was 20%. It's now down to basically 10% or so, even below that. That stability and that career mindset allows us to do a much better job for our clients. And what you've seen is the attrition of teammates has gone down. You've seen the attrition of customers gone down, and you've seen our customer scores dramatically improve over the last 15 years due to this relentless pursuit to be a career employer. So yes, we're very proud of the $25 an hour, but there's an economic benefit for the shareholder, and there's a great positioning for the teammate at the same time.
Brian, I wonder also what it says about the situation, the current environment. It's very strange that we're going into this decision with the Federal Reserve talking about 25, 50 basis points of rate cuts and maybe more. Your team has talked consistently throughout this morning about the amount of resilience they see in the US economy. Pay hikes like this aren't the kind of things you would typically see in a recession. What's your sense of just how tight or weak, loose this labor market actually is right now?
Well, I think if you think of 23 summer, the Great Resignation, it was very tight. Then it loosened up, and it's more imbalanced now. So our turnover rate in our company is running about 8%. Even in places like tech programmers, of which we have 30, 40,000 of them, we're running in double digits is now in 3-4%. And what that shows you, the bid in the market's different, which then shows you people are being more careful at headcount. And you heard some of my colleagues talk to you about that. So I think the unemployment rate is still low, but I think businesses are being much more careful in managing their headcount for a number of reasons. One is to get by understanding how all the policies are coming at them fit together. I'm talking about U.S. businesses mainly. And then secondly, they're also making sure that they're careful, and I heard some of my colleagues talk to you about this earlier, as you think about this application of technology, we know what this does. We have half as many people working in the consumer business than we did a decade plus ago. We have half as many people working in operations. We know that as these technologies could apply to our legal department, our finance department under Alistair, our risk department teammates, we know that if we manage the headcount carefully, we will do it. So we look at headcount very carefully and say, don't hire people unless you really need them. Not because we're trying to save money, because frankly, from a human management capabilities, we don't want to have people who won't be able to have a career here. So we just hired 2,000 plus kids from school. So we brought in all those new talent. We'll hire these 10,000 veterans. We'll hire these 8,000 people from community college. But each month we get the right to make a decision on whether we're going to hire about 1,300 to 1,500 people, and we're just managing that very carefully. So I think we're an example of what's going on in the broader labor market. You heard Wendy and my colleagues talk about it. All the companies are trying to manage this and make sure they get the headcount right, because that is a major expense for a lot of firms.
Brian, about a year ago, you were talking to us about the ramifications of AI and the explosion of efficiency. And you said that you think that headcount could remain about the same at the bank, even as the business continued to expand just in total size. I'm wondering if that's shifted, if you still see that as the natural progression of the relationship between the adoption of machine-based learning and the relationship to your headcount.
So there are two things. Now, one, I think the time we were talking, we were probably closer to 216, 17,000 people, or 213,000. So I think we'll be managing this down. But remember, at the same time, we're managing out through operational excellence and efficiencies of applied technology. We are deploying. So we're adding. Wendy's added commercial bankers in all the markets, and Sharon and the team added business bankers in all the markets, and Katie and Lindsay and Eric adding financial advisors and private bankers. So we're adding front-end people, sales traders, et cetera, to keep building out our capabilities. And so there's a reinvestment going on. The key to that is really redeploying people and reskilling them. So when we bring these 2,000 plus teammates in who just joined us in the last month and a half, we have to be more mindful about training them along multiple dimensions than we might have been 2 or 3 years ago. So I think, yes, I think ultimately the human being content of our work product would probably come down, but if we manage it right, it'll be flat to the same amount of people, maybe down a little bit, but all paid more and all being applied to the highest value tasks where frankly, the machines can't do the work. And that's the important thing. We know we know what this AI can do in today's world. Erica has been out there for 7 years, 3 billion customer interactions, 20 million customers using it all the time. We see what it could do. We took that and put it in our commercial business. We took that and put it in our internal process. We got other models to help in Jimmy DeMar's business in terms of a thing called Optimus and things like that. There's a lot out there, but what you're learning is it's still augmented intelligence, and that will be what's driving the near-term efficiency. So yes, I think the headcount management is one of the core tasks that managers have to take seriously.
I'm just wondering, Brian, as you train all of these new students, how do you make sure that they stay with you and don't go to some of your brethren across the way in the private asset sphere?
Well, we provide them a good opportunity, and look, they can go other places, but we've been able to retain enough that we're completely happy. And look, even for our clients, frankly, if they hire our teammates, it's not the worst thing that happens in all our businesses. But the reality is that we want these teammates to have a career mindset. In October, I'll celebrate our teammates have been with our company 50 years, 55 years, 60 years, et cetera. And you hear their stories, and their stories of I joined this company, I worked in a summer internship, I may even work part-time during college. I became a full-time employee, and I started doing this, and now I do that. And those are wonderful stories. And we have them tell those stories to our teammates to show you that you can have a long-term career at a company like ours, and that's what we want our teammates to come in with. They may not stay in trading or investment banking or corporate banking, but they'll have long-term capabilities here. And you've seen that even at the top of the house. Alistair was a capital markets head, and now he's the CFO, and so that goes on throughout the company.
They swear an oath of allegiance.
Yes, exactly.
Didn't you see them lining up this morning?
They came in.
Before they come in.
I promise on my cappuccino, which is very good, by the way.
Brian, I want to talk about the main event that takes place later on this afternoon. I'm not going to ask for your guess. I know how much you respect the team behind me and some of the official forecasts of the bank. I want to understand from your perspective, looking across the 8 lines of business, whether you see an economy, market activity that demands a rate cut from this Federal Reserve.
Well, you've had the benefit of all our experts, and we have the talented, extremely talented research team, and you also have some in line of business teammates talking about what they see out there. I think you have to back up. If you think about last year this time, the projected growth rates for our team was probably 100 basis points higher than it is today for 25, and so that deceleration of growth, the prediction that was largely based on a couple things. One, rates would stay higher because inflation was kicking in, the impact of the uncertainty in tariffs, et cetera, et cetera. All that's coming through the system now, so you're seeing some certainty fall into place on this. And I think also inflation was coming down, and I think so the tension the Fed has to deal with, and you've been picking at it all day, is the tension between a higher inflation rate and ultimately where Fed funds could settle in at. And so whether they do 25 basis points today or 50, people have to keep in mind the growth rate in the economy was brought down, and now it's starting to go back up. So next year is predicted to be better than this year, and the year after is better than that. So you hear our teammates talk about the economy growing back out, and that then means we're on the other side of it. And so the Fed has to adjust to the inflation picture as it got more in control. They can come down. They came down 100 basis points already. They can keep coming down, but they got to be very mindful of the inflation side. And so I think when the people get in the room and they see the data, they have to think it through. The big news since that you referenced earlier was the labor market's gotten softer, so that gave them concern. So I think the market believes and our teammates believe they'll cut rates. But I think the key for people is deceleration of growth, and will the growth reaccelerate? And you hear our teammates seeing that. We're seeing consumer spending strong and all those things, which would indicate we'd see the acceleration. Next year's better than this year. Unemployment is not expected to go up a lot, even though the employment picture may be softer. But the most important thing is the long-term interest rate scenario people are projecting is a more normal rate environment that we saw before the financial crisis. Say 3% plus or minus on the Fed's fund rate, 4 to 4.5% or so on the 10-year rate, and a curve that's not inverted, that's normalized between that. The important thing is to get back to more of a normal environment, frankly, with maybe a little higher inflation, because the great debate about 2% is something you can get lots of experts talk about. A little higher inflation, a little faster growth, and then, frankly, that'll help with some of the debt carry and other things going on in the U.S. economy.
Brian, it sounds like next year you see the bigger risk as potentially a surprising bout of inflation and some sort of downturn. Is that correct?
Well, I think the question is how do you tolerate the inflation and the nature of it, what's come from. But, and I think that's the tension of all this, I think, is next year as you get to the second quarter, as these policies are now in place and are behind us, are you going to see the acceleration and growth and where our businesses start investing even faster? If you listen, I think if you asked Wendy about it, she would tell you her commercial customers that have lines of credit are still borrowing less as a percentage of their availability than they did in sort of the 17, 18, 19 timeframe, where rates have been moved up and the economy was growing. And so why is that? They're probably not seeing quite the opportunity. And so they're trying to sort this all out. And well, I've got the benefit and the honor of leading a company that has this talented team behind us and all the talent and money we spend on research and everything. If I'm running a company that the three of us owned and it was a manufacturing company, I got to figure it out all myself. That tends to hold people back. So that would be the case for acceleration. And then the question is, if rates stay a little higher and the growth is higher, that's not a bad place for America to be.
Brian, just before you go, I wanted to sneak this in. One final question. Whose door do I need to knock for World Cup tickets? Who makes that happen here?
Well, you didn't bring David Tyree on, who's doing all our marketing and work. And so he's the guy that's got control of the tickets, but he does a great job for us. Look, our relationship with FIFA, we did the Club World Cup, which was sort of the warm-up, and next year, and you'll see us accelerate our efforts. We have great capabilities for our clients. But most importantly, this is a chance for America to showcase football, soccer as we call it. It's a case for these cities that are hosting to put on a great show. And I think I can see the enthusiasm building, and you're not the first person that's asked for tickets, John.
David Tyree. David Tyree?
Yeah, okay. Come on down.
Brian, thank you, sir. Appreciate it, as always. It's good to see you. Enjoy London. Brian Moynihan there of Bank of America. Let's take a step back and just think about this economy right now and what we've heard from this team in the last 2 hours and 30 minutes. It's not an economy or a market that's screaming for an aggressive rate cutting cycle. I think that's the message that we've received so far this morning.
And the question is, do you still have that reticence that's pulling back the inflationary potential, given the fact that companies haven't been investing as quickly? And that's what I'm actually really excited to speak with Jim DeMar about, just the M&A cycle, just how much banking activity is continuing to accelerate as people get that confidence underfoot.
I imagine the phone's ringing for David Tari as we speak.
Yeah, exactly.
Right? Yeah, I think he's going to be busier today than maybe expected. OK, coming up, some housing data. We'll get the view on the economy and the latest economic data with Aditya Barve of Bank of America. From New York City, live from Bank of America, this is Bloomberg. Equities just a little bit softer on the S&P 500. The opening bell about 60 minutes away. Got a few things to do over the next 30 minutes. We've got to get you the latest economic data, but also a developing story in the nation's capital in Washington, D.C. Let's head down to Tyler Kendall for more. Hey, Tyler.
Yeah, hey, John, good morning. Well, mortgage documents reviewed by Bloomberg News and Out this morning show that the Treasury Secretary, Scott Bessent, entered into a conflicting agreement obligating him to occupy two separate homes, one in Massachusetts and the other in New York, as his primary residences. This is from 2007. Both mortgages were signed on the same day and issued by the same lender, Bank of America. One property in Bedford Hills, New York, the other in Provincetown, Massachusetts. But evidence shows that the bank wasn't actually relying on these pledges, never actually thought that Bessent was going to occupy them both as his primary residence. And we did get a statement from one of Bessent's lawyers who actually had power of attorney and signed these documents for him, saying in part that Bank of America was fully aware the Massachusetts property was not a principal residence, going on to add there was, quote, absolutely nothing improper about Mr. Bessent's loan applications. And mortgage experts agree, telling us for this story there is no sign of wrongdoing on Bessent's part, but rather this could demonstrate how discrepancies on home loan applications aren't necessarily proof of fraud. And Fed Governor Lisa Cook's situation does appear at least partly similar, though not identical. Documents reviewed by Bloomberg News over the weekend show that on at least one of the properties, it was listed as a vacation home, and that the lender in that instance did not expect her to occupy that residence as her primary residence. Of course, John, as you know, this is playing out in the courts. An appeals court on Monday had ruled that Lisa Cook could retain her seat while the broader questioning of her firing ultimately plays out. But that court found that President Trump very likely violated her due process rights to defend herself against these mortgage applications. John, we are preparing for the White House to ready their Supreme Court appeal to that decision.
Tyler Kendall, appreciate the update. Tyler Kendall there down in Washington, D.C. Going to keep it on housing, but the kind of data you might be more interested in, housing starts, building permits. With the latest is Mike McKee. Good morning, Mike.
Good morning, John. And it's not particularly good news for anyone in the home building industry. Housing starts dropped by 8.5% in the month of August, and the July 5.2% increase was revised down to 3.4%. So the housing industry weaker than we thought. The building permits forecast is even weaker than we thought, down 3.7% during the month. Instead of 2.2% last month. It looks like at this point, builders are still on the sidelines and not moving, which has been something that President Trump has pounded on in terms of trying to get the Fed to lower interest rates. Mortgage rates have come down in the recent months to about 6.4%. But that's not where they need to be, according to builders. And if they get down into the fives, that might start people moving, and that might get the industry moving again. But that's going to take a little bit more than a quarter point cut from the Fed.
Mike, we've got a full picture of the data now. The last real data point going into this decision later on this afternoon. This one highly anticipated. The meeting itself, the individuals involved. Mike, you'll be in the room. You'll be in the news conference. What are you focused on?
Well, I think the first thing we're focused on in terms of what Wall Street wants to know is what's the path ahead. We're expecting 25 basis points today. Obviously, any kind of 50 basis point move would be a big shock and positive shock probably to the markets, but that's not expected. So what are they going to do in October and December, and how many rate cuts do they anticipate next year? That's what's really going to matter to the people who are investing money. And then beyond that, of course, we have all the questions about how Stephen Myron fit in with everybody and whether or not there are going to be dissents and whether those dissents would actually mean anything. So a lot to look forward to, and it's not going to be an easy press conference for Jay Powell.
Not at all. This one's going to be awkward. Mike, appreciate your time. Looking forward to covering the story with you later on this afternoon. Let's keep it on the Federal Reserve, sticking with the economy. The senior US economist here at Bank of America Securities with this to say: another cut in October may be on the table if the labour market were to weaken significantly further. But it isn't our base case. Aditya joins us now for more. Aditya, good morning.
Good morning. Thank you for having me.
Thank you for having us. 25 basis point cut expected later on this afternoon. How much guidance can they provide beyond just that?
I think that's going to be the key question. What does the dot plot show? So our base case is that the dot plot median will show only 50 basis points of cuts this year, so another 25 potentially in December. And the reason we think that it'll only be 50 rather than 75 is that if you look at the macro forecasts from the June SEP, they've actually aged remarkably well. Unemployment is on track to meet their forecasts, so is inflation, and growth, if anything, will come in a little bit stronger. Obviously, you've already heard a lot about the risks of reacceleration here. So given that, and given that the dot plot median almost showed one cut back in June, even a little bit of a dovish move would still probably keep it at 2.
When you talk about a dovish move, there's a question about the actual cut or the signal going forward. Not just the signal in the number of rate cuts, but something Mark Cabana, your colleague, talked about earlier was the idea of the third mandate, the idea of keeping rates moderate over a longer period of time as one of the 3 pillars of the Federal Reserve. If that were adopted, how much would that change your outlook as an economist?
So moderate is not a clearly defined term. So we'll have to see if going forward, potentially different group of people at the Fed have a more specific definition of moderate. But for now, what I see is an economy that's probably pretty close to the neutral rate. You look at where stocks are, you look at the fact that productivity might be picking up, and I don't think there's a clear case here that the economy is screaming for rate cuts.
If that's the case, why isn't inflation more of a concern? Why aren't we seeing that baked into market expectations just a bit more?
So you are actually seeing inflation fixings showing a little bit of a pickup in inflation. Our core view has been that it's not just about trade policy, it's also about underlying inflation. And underlying inflation for us is stuck around 2.5%, and we think it'll remain that way going forward, which is why even as the tariff effects roll off next year, we only have the core PCE going down to 2.6%.
There was quite a difference between July Chair Powell and Jackson Hole Chair Powell. And I understand there was a big payroll report in between, but there was a difference in approach in how he anchored his view around the labour market that got my attention. He anchored his view around the labour market, around the unemployment rate in July. And then we got to Jackson Hole, and clearly he was spooked by the step down in payrolls growth. You've been focused on measures of slack, and now traditionally that's something the Federal Reserve and monetary policymakers would be focused on too. Have you seen a significant deterioration in measures of slack alongside this monster step down we've seen in payrolls growth?
So what Powell said in July, which was viewed as very hawkish by markets, was that even if payroll growth is 0, if the unemployment rate isn't increasing, then that's where break-even is, and the Fed doesn't really need to be concerned about that. And what we wrote at the time was it's one thing to say it, and it's another thing to walk the talk when you actually see the data. And that number, that 258,000 downward revision, I think it spooked the Fed. And yes, there's been some deterioration in signs of labor slack. You can look at the ratio of vacancies to unemployed workers. You can look at the labor market differential from the Conference Board. All of those are showing some increase in slack, but it's been relatively moderate.
Spooked them into what? I think that's what we're wrestling with today. Spook them into a 25 basis point risk management decision, or spook them into, we need to come out and convey to market participants today that this is the journey back towards neutral. And we think neutral is around 3, and we're looking to get there quickly.
The committee is going to be divided on that question. And the key question that we'll get answered today is, where does Powell land? Is he on the side of we need to do a little bit, but we don't need to do a lot? Or is he on the side of we need to go all the way back to neutral? We're in the first camp, but we'll learn more today.
How much are you going to take true signal from whatever Governor Myron has to say? How much is he the new lodestar in some ways of the committee in 2026, if not today?
I think it'll depend on how much the committee changes next year. That's still an open question. We don't know how many seats will be available on the board. We don't know how much turnover potentially there'll be amongst the regional presidents. So that's, I would say, very much an open question. But for this meeting, we know that Governor Myron will be an outlier.
Aditya, it's good to see you. Aditya Bava there of Bank of America Securities looking for a 25 basis point reduction later on this afternoon, but raising some big questions about just how much more this committee can offer beyond that.
This, to me, is the ultimate question. How prevalent is this inflationary risk in markets, and how realistic could it become should you get some sort of outsized move or outsized indication of what they're planning to do next year?
Throughout the whole of this morning, there's been a pretty consistent theme. Fairly resilient economy relative to maybe some of the spooky headlines around payrolls growth. And the real risk, perhaps not the base case, but the real risk that we get a re-acceleration through next year alongside some sticky inflation.
One of the most important conversations was around the retail sector, I found this morning, which is the true test. When they raise prices later this year into the fall, into the winter holiday season, how much do consumers push back? How much do they allow those to keep going? And if that's the case, that they continue to adjust to higher prices, that's a very different inflationary backdrop.
There's nothing easy about this afternoon.
No.
Maybe cutting 25 basis points is an easy decision to make, but there's nothing easy about the kind of guidance you can provide in a moment like this.
Do you think that Jay Powell can just get up and say, look, we're going to cut 25 basis points. We don't really have anything else for you. We don't know more than you. Thanks so much, guys. Peace.
Just start rolling up the statement and start throwing at him.
Exactly. And people ask questions. I don't know.
Yeah.
Do you know?
It's going to be a lot of questions. Where's Stephen Myron?
Yeah.
Let him lead the news conference. We want his thoughts on things.
That would be interesting.
OK. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief with our top headlines. It's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. House Republicans have unveiled a stopgap spending bill to keep the U.S. government open past an October 1st shutdown deadline. The measure would keep agencies operating through November 21st and provide new funding for security. The bill needs at least 7 Senate Democrat votes to overcome procedural hurdles, but does not include healthcare policies that Democrats have demanded. President Donald Trump announced a deal to keep TikTok running in the U.S. According to the agreement, which is yet to be finalized, U.S. companies including Oracle, Silver Lake and Andreessen Horowitz would take an 80% stake in the social media app. China's ByteDance would own less than 20%, satisfying a 2024 U.S. law that required the Beijing-based company to divest. StubHub is going public. The ticket platform priced its IPO at $23.50 a share, raising $800 million. The offering values the company at over $8.5 billion. StubHub will begin trading on the New York Stock Exchange today under the symbol STUB. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for this morning. Up next on the programme, we'll catch up with the Bank of America co-president Jim DeMare as we count down to the Fed decision later on this afternoon. Live from New York City this morning. Good morning.
The tension the Fed has to deal with, and you've been picking at it all day, is the tension between a higher inflation rate and ultimately where Fed funds could settle in at. And so whether they do 25 basis points today or 50, people have to keep in mind the growth rate in the economy was brought down and now it's starting to go back up. So next year is predicted to be better than this year.
That was Brian Moynihan, the chair and CEO of Bank of America. I think we should sit on those comments just for a few beats. I think they're important. We're going into this Federal Reserve decision later on this afternoon. People are looking for a rate reduction and some aggressive guidance into 26. And you've got the CEO of one of the biggest banks in this country, one of the biggest lenders to companies across this nation, talking about the prospect of growth picking up next year and inflation remaining sticky. I think that's something to keep in mind going into later this afternoon.
Especially, and let's build on that, this idea that rate hikes didn't necessarily put the brakes as much as people had expected on the economy. How much will rate cuts cause a spur to that reacceleration, really add some fuel to the growth that potentially could already be there in the form of more borrowing, more mergers, more activity more broadly?
We can continue this conversation as we count you down to that Fed decision later on this afternoon. I'm pleased to say that we're joined by Bank of America's newly appointed co-president, Jim DeMare. Jim, it's good to see you.
Great to see you.
Is it Jim or Jimmy? I'm always confused. Brian called you Jimmy.
You can call me whatever you like.
We're going with Jim.
Either's more than acceptable.
Jimmy, congratulations. Congratulations.
Thanks very much. Appreciate it.
It's fantastic to get some time with you. I want to start by talking about markets before we talk about the operational stuff. I've lost count of how many quarters that you've seen growth in the markets unit. What are we on now?
13 as of the second quarter. Earnings are coming soon. We have to wait till those come out, but we indicated at the Barclays conference last week and when Brian spoke before, mid-single digits for the market. So, knock on wood, we should be at 14.
Where's that growth coming from, and just how crazy was the start to Q2? 25.
Yeah, I think for us it's been a story of having the additional financial resources to help clients execute what they want to execute, because markets have grown considerably in size and market value. And taking a step back from that, for us, our equities business, it's been a huge focus for us the past 4 years, investments in financial resources plus people plus technology. And then within the FIC kind of sector, if you will, the rates business has been a place where we haven't done as well as we think we can, and we've seen a turnaround there as well.
Maybe the Fed will help you out, especially today.
A lot of anticipation, as you mentioned. Great deal of variance in terms of not necessarily this meeting, but what the next 6 to 10 months brings us.
John alluded to it, and I think it's a really important point. There's a tension between this push for the Fed to ease financial conditions, given the fact that financial conditions, at least you could probably tell us, but other people have told us, seem pretty easy.
Yes.
They seem like pretty free-flowing, and people can go out and borrow money if they need to. Can you square that circle for us?
I think what we've done a very poor job of is talking about financial conditions based on size of companies or individuals themselves. We've broken it down. You had Liz on this morning. We were talking about small business and what's going on there. Smaller businesses and on the lower end of the economic kind of scale, if you will, for individuals, they're more sensitive to short-term rates and floating rates. So, if you're a large corporation, you've had easy access. The markets have been very favorable. You issued you refinanced debt back in 2021, and you locked in some very low rates. Homeowners did the same. Mortgage rates were below 3%. And again, if you're a smaller business and you relied on floating rate debt and you don't have access to the broader capital markets, this will be a relief. So I think that's a story that people should focus on.
So I guess that another way of saying this is when the Fed started hiking rates, people were surprised that the economy didn't just tumble into recession. Are we going to be surprised by if the Fed cuts rates, how little it helps boost growth? Or do you think that it will boost growth substantially, that we will see M&A pick back up, that we will see borrowing increase even more?
I think we're going to have to, again, bifurcate it and take a look at different parts of the economy and see who's benefiting. But to your point on M&A and activity, for all the pessimism and climbing the wall of worry, there's a lot of activity happening across a lot of sectors, whether it's, tech, energy, utilities, power, data, financial services. We just saw, an M&A activity, and, there's more discussions on that. Healthcare, I don't know. Equity prices are high.
Look at how this market's priced.
And people and companies are making money.
So where on earth are we going? The Fed's about to juice the whole thing. How are you thinking about things? You've seen so many cycles. What is this? What is this moment?
Well,
the Fed's spooked by payrolls.
It's a very different one. That's for sure. There's some information we put out recently that showed, when the Fed is cut, almost I think it's been every single time, and I don't remember the exact number, but into a strong kind of equity market, we continue to get a rally for the next 12 months. So that's there. We'll get
Rally's
you the stats,
one thing, but can I just push this point? I want to understand from your perspective whether it's something more than that, whether some kind of great misallocation of resources is building here. I can't think of many times where I've met investors who are incredibly aggressive about the capex spend of a handful of companies.
Yes.
It's sent the equity market to all-time highs.
Yes.
And the Federal Reserve, again, is about to come out later on this afternoon and juice the whole thing by even more potentially. I understand what they're responding to. It's the payroll story. I want to understand the consequences from a market perspective, just how dicey things might get further down the road.
Again, I think we have to see a considerable drop in longer-term rates to really get that traditional impact. We had an inverted curve for an extended period of time, which everybody indicated should indicate a weakening economy, which we didn't see. And to your earlier question, I don't think we ever had in history fiscal and monetary policy at odds, and that's what we had. I mean, everybody talked about, well, rates are up 400 basis points. Well, we also had the largest spend by the federal government, in history, not only in absolute dollars, but as a percentage of the economy. So the policies weren't aligned. We talked about it a bit then. 2 years later, 3 years later, we're talking less about it. But I think it's going to be, is this going to be inflationary? I think people have to also think about fiscal policy and what's going to happen there relative to what the monetary policy is.
There's also the idea of deregulation, which
Yes.
we've seen in quite a bit. And that's one reason why people have been very optimistic on
Yes.
the banking space. Does that allow you to take more risk and compete more significantly, say, with some of the private asset managers that have really made more headway into the space?
Yeah, I think for us and for the industry on regulation, it's more about clarity, which is one of the things that we've talked about a great bit. Whether it's stress testing, some things on SLR, GSIB, those are all things that I think play an important role in regulation and in a safe environment. But a lot of questions around were they too restrictive and compounding as opposed to kind of catching the bubble or the balloon from squeezing out in another direction. I think one of the in the broader economy, I think there's a lot of regulation that's occurred that we're less familiar with because we're not in that environment. But if you go across the country in many industries, the excitement is around less regulation there. I think it's going to be less about us, quite frankly, and more about for the broader economy.
I wonder how much we keep talking about the dollar as the backdrop here and how much it's been weakening. And I wonder for you, as the head of capital markets, the co-president of a bank that has America in its name.
Yes.
How much more difficult it is for you to compete globally at a time where there's a real question about U.S. policy, about the dollar, and about what the relationship is going to be.
Yeah, it's certainly, it's certainly a topic, meaning the dollar. We're a global business. Yes, we are. We are Bank of America. We have a dominant, position in the U.S. We've grown our, international business, which I didn't highlight when we're talking about areas of growth, but international is a focus for us, not expanding beyond where we are, but just being more meaningful in the regions that we are. And, we just look at it and say we have global capabilities and, we can transact and warehouse risk where we need to, for clients. One of the big, I think, misunderstandings or where it's not thought through enough, it's going to take some considerable time for this to occur. We're looking at, weakness in the dollar, 10%, 15% versus its peak. We're still the largest capital markets to invest in. And you just have to keep that in mind.
I wanted to finish by talking about you.
Yeah.
You've had a pretty tight remit for quite a while.
Yeah.
Are you excited about the prospect of stretching your legs a little bit, having a look at other business lines?
Yeah, I mean, I've been in the markets business 35 years in different, capacity, but I've always had interaction across the firm, whether it's been investment banking or corporate banking or whatever it may be. And I think if you take a look at, these areas of where Brian talked about organic growth and where we can do it, I think there's some considerable opportunity for us to be more consistent in our delivery. We did it in the markets business. I tried to de-emphasize FICC versus equities and think about markets and how we can deliver for clients. And I just view this as an expansion, of that and trying to help everybody bring that to fruition because, ideas are great. Execution is everything.
Does that mean spending less time with these guys? Are they going to miss you?
I'm going to miss it. I've sat on a trading floor for 35 years.
Yeah.
It's a great thing. It's been a great experience. It's given me a lot of opportunity. We have a lot of talented people that, as I said in the meeting we had earlier in the week, I know everybody's saying congratulations. Now the next question is, what about me? Which is for everybody else in the room. What does this mean for me? And, we're going to be making those decisions over the next couple of weeks. But we're pretty excited about it. Team's pretty excited about it. And response has been very good.
We'll give you some space to figure that out. Jim, I know how much you love the markets business, and thanks for spending some time with us. We appreciate it.
Great to see you guys.
Jimmy DeMar there of Bank of America, the newly announced co-president. Very cool.
Yeah, very cool at a time of incredible transition technologically, but also economically at a time when the markets continue to keep grinding higher.
That does it for us. A special thanks to everyone here. Thank you very much, and excuse us for all the noise. You get your home back. We'll be back a little bit later on this afternoon, 1:30 Eastern Time, a Bloomberg surveillance special, The Fed Decides. From New York City at #1 Bryant Park, the home of Bank of America. You've been watching Bloomberg Surveillance.